have on your radar? What should we be watching?
Well, if we look at economic data there, we got to go really towards the end of next week. Ben, we got durable goods orders here for September out on Thursday there. Now, this is a volatile number month over month as well, too, but we're looking at the overall trends there. It's been up 8 of the past 12 months, expected to be up again here in September, up 0.6%. Now, these are big, durable goods. These are, it's higher cost items as well, too, that last for a long time as well, too. So this is a good kind of proxy there for consumer spending on higher price items as well as business spending as well too. And then we also have, like I said, that third quarter GDP, the first estimated here as well too, 4.1% expectations, Ben. I mean, that's the highest we've seen in, almost 2 years as well too.
Yes.
And it'll be the 5th consecutive month of growth there as well too. It was the first 2 quarters of 2022 where we saw those negative growths here, but the economy is doing quite well. Then we got Friday there. I think that's probably the key data that a lot of folks will be looking at this week. Personal income and spending, moderate increases across the board, 0.4% for income, 0.3% for spending. And of course, the Fed's favorite inflation gauge, core PCE, 0.3% up month over month here in September there, but it's that year over year rate supposed to track down from 3.9% to 3.6%.
Keep reverting back to that comment from Fed Chair Jerome Powell a couple weeks ago about above average growth and how that could lead to further rate hikes. That seemed to get kind of swept under the rug yesterday. Not a lot of focus on that. I'd imagine our attention should be on the numbers next week, though, to see if that continues to play out. You mentioned some of the strength we've seen there. Michael Zaremski, appreciate you joining us here. A look ahead to next week, as well as taking a quick look at the week that was here. Rick DeCat's joining us because when you're talking about the week that was, you're talking about yields on the move higher. Mike was just talking about how, well, the data has been showing a strength in the U.S. economy. Yields reflection of that.
On the move is definitely a good way to describe what's been going on here. We've moved from just around 4.2 to almost 5 in less than 30 days here. So really strong movement to the upside, especially during the past couple weeks here. Just this rising wedge type shape here. We did have a little bit of a downside breakout from this pattern yesterday, but we're back within the boundaries of these 2 trend lines here today. Now it'll be interesting to see if we can crack the 5% level. That could be a potential resistance point, but I don't know if I would want to bet against a trend like this here. In terms of support, if we do start going downward here, 4.88 was about the site of a double top that we saw here. We saw a little bit of a price bouncing around that level as well. If we do start to back off, that would be the first area I would probably look for support.
Yeah, a couple things I think are notable here is the pullback Rick mentioned, very short-lived, right? That's what we see when we talk about a trend to the upside. You see underlying price activity and continuing in that direction, and counter-trend price activity doesn't really have a lot of follow-through. And in this instance, this is exactly why we talk about the trend being your friend, right? Because the market does the work for you. I mean, if you're trying to play these individual small pullbacks that we've seen here, you've got to be very quick. I like to think of it as kind of like picking up nickels in front of a steamroller, right? Watch your fingers. I mean, because it could get painful. Talk to us about, as we take a step back here, I'm curious, this is in many ways, one could argue, unsustainable here, right, Rick? Where do we at some point run into some resistance?
Right about here, to give you a very simple answer to your question here. Not only because we're about at the 5% mark, which is
psychological
level.
Exactly.
Yep. Technical analysis typically discourages just arbitrarily looking at round hole numbers here, but people still put weight on them sometimes. They're often, for stocks at least, natural points where people are doing option strikes and stuff like that. Maybe not exactly the same situation here, but we do have some technical basis because we're right on our +2 standard deviation channel. So we've got our blue linear regression line, our line of best fit. We take standard deviations above and below that to create these channels where you might find support and resistance. So our +2 channel comes in right at 4.965, almost on the nose where we are right now. So this could be a point where we see a pause. Not saying that's a guarantee for sure. Just because something is high doesn't mean it can't keep going higher. We've seen it happen many times with the stocks that we cover here. If we do keep going up, potential resistance around 5.33, that would be a big move as well here. And once again, not saying that will happen. Just this is a projection that we can look at to give us some idea of where this product could go here. But price action was mostly contained within this upward channel here. Upside breakout. retracement back to our 21-day EMA, but on the move again to the upside here. RSI, a little bit of bearish divergence here. We also, I thought it was pretty interesting, we did not make our way into the overbought area yesterday. So that's another piece of evidence that we could be in for a bit of consolidation here, a bit of stabilization here. I think that's probably a little more likely than some kind of price collapse, would be a bit of sideways movement perhaps as traders take a breather.
You know, I'm thinking about Mike Zremski was just talking about how this week people are buying hard assets, right? Gold, for example, he talked about. If we start to see geopolitical tensions further, ultimately, maybe we would see a little bit more buying of those traditional treasuries, for example, that safe haven type buying. Buying the futures would send yields a little bit lower, so it could run into this area where he's talking about how it's interesting how the fundamentals in a weird way line up with the technicals, so that 5% level. Let's definitely keep an eye on the geopolitics over the weekend in terms of this product as well. Let's take one more step back here, Rick, in terms of we've got upper levels established here, lower levels established here. Wow, look at this here. It really speaks to the move up, not only in terms of the magnitude of it on the right side of your screen, but also to where we are as far as duration, all the way back to 2007 levels.
Yeah, just for context, a 20-year monthly chart here. Look at how steep this move upward has been. We had rates, you know, very low, almost at zero during our COVID problems here. But, you know, we're at our highest level, as you said, since July 2007. Very little time spent above this area.
You know, this disruption here that we saw in the pandemic, you can see the speed that we saw rates decline, and the retracement here in a very similar fashion speaks to the disruption.
Yeah, exactly. And, you know, we can see that we had a little bit of a downward choppy phase here once we get around 3.6 to 4 or so here, but just rocketing upwards since that point here. We might have to take this chart back even further. You know, I think it goes back to 1997, and rates were higher during those periods as well here. So there is some historical context for all this stuff, not that terribly long ago here. 1997 actually is pretty long ago, now that I think about it. But, you know, it'll be interesting to see if we stop around 5%, like I said, because that seems like if we're going to stop anywhere in the recent price activity around where we've been trading, that seems like probably the place to take a pause.
Yeah, I'm reminded of rates of 5% on a historical basis, and Bob Iacchino, others were talking about this on the show this week, kind of in the middle of the range in many ways. We're so used to these historically lower rates, but I also want to point to this chart here. It kind of reminds me of the US dollar on a daily candle chart, the breakout we saw below 100 and then the V bottom, the rally back that we saw. Again, time frame being very different here. We're looking at monthly candle charts here, but appreciate Rick joining us this morning, the chart master, to take a look at the 10-year, the run-up we've seen this week. Keep an eye on the ripple effect next week, and thanks to you for joining us to talk futures here this morning on the Schwab Network. There's lots more to come. Headed your way next, Morning Trade Live with Oliver Rennick.
Good morning. October 20th, 2023. We're going to be streaming the stock market, watching SPY, GME, AMC, whatever comes our way. I've got about 30 minutes to the opening bell. Be waiting for some setups for some daily options today, probably mostly on SPY. It is an OPEX as well, October OPEX, and so could be volatile. I kind of reversed a couple days ago, and volume has actually picked up, so we'll see. Hopefully some good trading ranges for today. To end the week strong, thank you for being here. Sub up, like up, comment down. Happy Money sticks around. You can follow us on Twitter at HappyMoneyYT. And we have a Discord server. Link for those are in the description. Flash Crash Friday. Wouldn't expect any less from you, Bubba. Morning, Juan. That is working. Are you working this morning? Have you thumbs up the stream? See two of you. Thank you, two. Thank you, two, for your likes. Tesla's down 1.5. Tesla's almost down 10% yesterday. With volume. GME dropped 5% yesterday. AMC was up 2% yesterday. Like Phase is up 21% pre-market.
this year. And so as markets price down those odds back to the low 30% of a hike by December, the 10-year yield moves, but the 2-year yield doesn't really follow.
Now.
And the dollar doesn't really follow either.
Yeah,
The
that's been
question we're
working, I
trying to
think.
figure out is,
I don't
if
know. I saw your morning
stocks are
comment.
going
Nothing
to
before that.
enjoy this environment. Are they going to survive in this environment? Are they going to thrive? Right now, the equity market basically has just said that as long as yields go up, stock investors don't really care the rhyme or reason. They don't like it. The correlation remains very consistent here. It's not rocket science figuring out why stocks have been under pressure. Yes, there is some exogenous stuff, but there is also the core macro pressure of bonds, and the yield is just not stopping here. So even though the curve steepening is a good message most likely about the economy, stocks still haven't liked it because the move has been extreme. Yesterday, again, a pretty juicy sell-off in bonds. Now, a few other things to keep in mind here that's complicating the picture and making it a little bit more hard to read is the fact that we got gold rallying back. This very likely could just be due to the geopolitical risk that's out there and investors buying gold as a safety trade again. But it's also pretty wild that gold is doing this even as yields are shooting to the upside and real yields are going higher, because that's exactly what gold typically doesn't like. So this is kind of an uncharacteristic move for gold, even with the geopolitical stuff is an arguably bullish catalyst for gold. So we want to watch to see what this does, and maybe it gives us some insight into perhaps what comes next. Also watching Bitcoin too, because BTC in the crypto world has its own set of catalysts with the lingering ETF approvals, but you always still want to just keep this in mind as a potential indicator for risk tolerance overall. Perhaps it's just being driven by crypto stuff right now, but if Bitcoin continues its strength to the upside, you probably want to be watching for stocks too to maybe firm up. Bitcoin does still, I think, have a connection to the Fed and to interest rates, and I don't think it's surprising that Bitcoin finds some strength when the dollar remains soft, even as yields are going up. The fact that we're getting that steepening and the fact that we're getting the dollar under control means we're not getting an aggressive hiking regime. So gold, Bitcoin, TBD on how these things fit in, but we do want to keep them on our periphery for awareness as traders. I got Kevin Hanks joining me here this morning, host of Fast Market. So much to choose from here, Kev. At least today, the calendar and the schedule is a little bit more quiet. So what's going to move us?
Good morning, Oliver. Yes, sensory overload today on things that can move the stock market. First and foremost, I think we're still coming off of Jerome Powell's comments yesterday. I think some of his comments were, you and I talked about this yesterday afternoon, really incredible, and you saw the market move based on them. So I expect some of that to continue in terms of the choppiness. Then, Oliver, we have another Friday where the markets are going to be jittery based on the uncertain geopolitical and what might happen over a weekend period when the markets are closed. I think the risk-off assets, you mentioned gold, even bonds are higher this morning, bonds and notes, which causing yields to go lower. And then VIX. VIX is elevated. It's down to start the day, but I would pay close attention to VIX. These risk-off assets, then you throw in a dollar that's been relatively muted, but crude oil, which has been incredibly strong, now over $90. I think this world is bracing like it did last Friday for a jittery weekend where there could be headlines going on between Israel and Gaza. Now, that being said, that's one reason to make the markets interested in jittery. Now you've got a mass amount of economic data coming out next week, 3 of the top 6, and then you've got a massive amount, 824 names coming out with earnings next week, Oliver. 164 in the S&P, 24 NASDAQ, 12 Dow. It'll be a massive week, and not only is it big in numbers, it's big in profile, right? It's Meta, it's Microsoft, it's Google Alphabet, it's Amazon, it's Intel. It is a who's who of large cap tech coming out with earnings next week. And frankly, some of these stocks have run a long way. So there's issues there that could cause problems. You think these stocks can't move up or down? Look at Netflix, right? These stocks can make outsized moves on some of these events. So you've got geopolitics, you've got economic data, You've got earnings all coming out on the calendar. I think this market spends the majority of today in the jittery category, Oliver.
Jittery, I like that because the VIX near 20 is at the higher end of where it's been the last 7 months. The other thing, to your point, too, about earnings as well, the fact that that could be another catalyst for volatility seems to ring true after yesterday's sell-off in Tesla in particular, because if you get selling by way of earnings, it's a different type of environment than selling because of bond selling. So far, we've kind of gotten a little bit of both. But if the bond move calms, which it is this morning, right? There's a little firming here in treasuries. We got the gold trade up too. It's a different picture if the market doesn't like earnings. That's a different type of sell-off. That's the type of sell-off where bonds might work. Maybe a gold trade works too. So I think that given the bonds yesterday didn't get worse after jobless claims and that gold remains bid, to your point that maybe there's also a very specific corporate catalyst that we have to keep in mind here with so many earnings still ahead.
Yeah, next week is a big, remember,
What's up, guys? Good morning.
Banks, and we knew what was expected with the banks. Airlines, we pretty much knew what was expected there with, with higher prices and demand fighting with capacity. Now we're getting into large cap tech. And Oliver, think about it. The first two names that come out, Tesla and Netflix, two different directions, two different reactions to two different stocks. So, Meta, we can go through that. Meta is a name that we screamed, we pounded the table for months that Meta, how cheap it was by earnings. Well, it's not cheap anymore. It's actually quite elevated, which you can say for the rest of the S&P as well is quite elevated in terms of price-earnings ratio. So there's a lot of risk here. A lot of these stocks, where they sit right now going into earnings, are fully priced going into earnings. That means the majority of the risk is to the downside, Oliver. Valuations are not cheap in some of these large cap tech, as you know, NVIDIA and some of the chip makers. So you've got to add that with some geopolitical risk, and boy, the choppy October is really living up to its nickname, Oliver.
Yeah, we dubbed that a couple of weeks ago, and I think it's working out well, right?
Yes.
Bad September, choppy October. Kevin, the other thing, too, just to that point again about yesterday's moves, because today's kind of quiet, as far as data go, not really anything coming out. Fed speak, we got that through yesterday. But the fact that we got the 2-year down again this morning, and yesterday as well. The story for bonds is still remaining very limited to the long end, and I do think there's some sliver of hope or a silver lining to even some more of the aggressive tone we heard from Powell yesterday, that it's just about staying higher for longer. It's not about hiking more from here, and that's got to be at least some solace to this market to some extent, that the 2-year yield is not blowing out.
Yeah, we may have to change some of those phrases from higher for longer. We did that. Now we're here for longer, right? I mean, I think Jerome Powell, unless the data tells him different, is pretty satisfied where the Fed funds rate is right now. He said that. He said there's evidence that policy is not too tight right now, but it also says it may just be that rates have not been high enough for long enough. So he's talking about duration now, not levels in terms of the Fed funds rate. So I think Jerome Powell feels good about where they are. Now he's talking about how long do we stay at these levels and let it work. I think he's satisfied with it. I think like I said, the fact that he was so balanced, he almost did a Janet Yellen impersonation going, saying something dovish, saying something hawkish, dovish, hawkish. He went back and forth. You saw the markets all over the board when he was speaking. So I think that part is going to play out over time. It's now switched to duration, but boy, that's just one thing we have to worry about today, Oliver. There's several. Geopolitical might take over some of the rhetoric on today as we move into the weekend. That's why I think the risk-off assets are so important.
Okay. All right. Thanks, Kev. Appreciate it. A good look and follow-up from yesterday. Let's look at some charts. Ben Lichtenstein, host of Futures, join us from the newsroom. So, Ben, today we got a little firming in that bond market on the 10-year, but again, because things move so violently to the upside in yields, seems like this isn't really much we should spend too long thinking about unless there's a big reversal.
Absolutely agree, Oliver. I think the key word there is little, right? Because in trading, there's a saying, and that's the trend is your friend. And I like to say continuation more likely than change. And we're definitely seeing why, as bonds to the downside have been a textbook example of that. Let's take a look first and foremost at the longer dated 30-year on the left and the shorter dated 10-year on the right. In markets, you hear words like oversold and due for a rally. I mean, when you look at a chart like this, you could say that, right? But still have yet to get that. And so that's why I think trading, you know,
I like the trend is your friend more.
Absolutely has to be based on, because in that
So
instance,
just
the
the
market
buzz.
does the work for you, right? You're not trying
Finally
to catch
click
these
the
small
link.
bounces and everyone's
This
talking
is
about
where you
these
found our
bounces,
Discord
3,
from, right?
5, 10 ticks, but you can see the real money's been made on the short side here. Taking a look here at the acceleration really is what's raising some eyebrows this week, but also the fact that we saw the 2-year, the shorter end, start to participate. And yeah, we're off the spike high we saw to near 5.2, but Oliver, almost at 5.25 here on the 2-year. I mean, I think that's significant. This is what we were just looking at a minute ago in terms of the 30-year. On the left, the 10-year on the right. Kevin was talking about higher for longer, how it shifted
just
to
checking some
here for longer. I
different
think
plays I
as
have.
we look at stocks
Looks like
and kind of tie them into discussion, especially the Russell and what we've seen this week.
reading
I
about
think for the
Sunrun.
bulls, it's more hope this doesn't continue than anything else. I mean, look, we're breaking down below 1,700 here, testing that level. This is starting to weigh on small caps.
Okay.
One of the solar stocks had
That's really,
earnings
really
and
close to
pretty bad.
fresh breakdown. I mean, usually it's the type of thing that puts
Just
you on
pulling
alert
down
for
all
the
the
rest of the
solar
indexes, and I think
stocks.
it probably does here.
Demand in Europe
but
is
there's
bad.
a big difference between that chart over the past year and
Solar
the S&P
Edge
and the
reports
Nasdaq.
big
So
miss.
the Russell has been so far behind for so long that I'm not sure it's going to induce a panic across the bigger
I have a
stocks
short
just
on
yet, because it's already been
A lot
so
of
weak.
EV
But
and solar
generally,
stuff.
you know, it's
Mostly
not
just
good
green
sign.
stuff, really.
Yeah, no, I'd agree. Russell has been a bit of an outlier here, Oliver, but we know what we saw back in March, the impact that had on the broader market. If we see some of those regional
most of my
banks
options
come
are-
under
they're like
scrutiny, and with this run up in rates, I wouldn't be surprised to see
way out
that
the money,
at some point. But
lots of
I also
time,
want to point to another
more for like bankrupt.
potential headwind here for stocks. If this
don't know
continues
if I have enough time,
to
though.
worsen, that's the situation in the Middle East, and you've got crude, which
don't know if we're gonna have
so
enough
far
time.
has remained relatively contained, right? But it does seem like involvement's been broadening, and it's definitely a situation to watch over the
About
weekend
15 minutes
and
to
into
open.
next week, as it's been ongoing, and as mentioned,
Only
very
thing I
volatile. You got
recognize
an upper
on
extreme around 95.
market that's up,
On the left side of your screen, the lows
phase.
around 81. We
Phase is
recently
up
came off of
22%,
right in
not
the middle of
sure
that range. And
if
to your
that-
point here in terms of stocks, the S&Ps versus the Russell, I think this is a big part of it. The fact that we've managed to
Just
hold
penny
within this
stock
range, take out
bouncing.
that upper extreme, Oliver, and I think that'd be a bit of a different story, especially with rates accelerating the upside. Geopolitical tensions tend to weigh on the indices. You can see here holding above the 50-day moving average, and again, how significant 95 is, because it also coincides with the highs that we saw last fall, just sort of bringing these two conversations together in terms of, one thing I did want to remind you is that we haven't seen RBOB, right? Gasoline prices still remain relatively tame. I think that's also what's helped the bulls kind of remain optimistic. But again, just bringing these two conversations together, you've got rates, you've got crude right here, and we've been watching crude just kind of lagging to the upside a bit. I'm reminded of how oftentimes when you're talking technicals, it's the fundamentals that get the technicals to kind of come back into line, and this has been a bit of a divergence that could be resolved with crude to the upside. If geopolitical tensions worsen, ultimately, Oliver, that would definitely impact the Fed and further complicate the situation they're dealing with.
Yeah, absolutely. I do like that, because right now, if bonds are going to make the same move in relationship with crude that they had last year, then crude probably looks like it's got some more upside there. But WTI so far, you know, contained, still below 90 bucks, but we're pushing it now. We're really pushing it, so it is bouncing back for sure. Thanks, Ben. Nice looking.
GNS had a big pre-market for some reason.
Joining us from Talback and to tell us
Just
what he
liquidity.
thinks
It was up like
about not
25%
just
at one point.
the Fed's testimony yesterday from Jerome Powell, but also the earnings and everything else. We got a lot to get through here, and a little over 10 minutes.
BFS never got it really another bounce. One and done. was interesting hearing S3 partners talk about what would have crowded shorts in them. Beyond Meat was on there. Fisker, a couple other EVs. Still have quite a few earnings to get through. All these charts have earnings the next 2 or 3 weeks. Oh yeah, there's news on Enphase. What was that this morning? Oh, was that just from Solar Edge? Oh, there's some other news on Enphase. Looks like it's probably down from that Solar Edge earnings as well. Yeah, that really is hitting 13% pre-market. What's Solar Edge ticker? Oof, down 30%. I closed one of my puts on AI yesterday. For loss, actually, just too far out of the money. Made all this way and it didn't go up in value at all, which makes sense. It was just too liquid of a chain, I guess. Too far out of the money. Your Bobby liquidated? Is it's not showing up on your portfolio anymore?
Have to look at positioning because it means if everyone's on one side of the boat, they're going to lurch back the other to the other
about
side.
8 minutes
But the
to open.
positioning last week, this date is collected on Tuesday afternoon. So last Tuesday, after the this
That could be
attack
kind of
in
choppy.
Israel,
Yesterday's
traders
big
had
move.
the opportunity to close out shorts, and they didn't. In other words, even with that shock, they were still pressing this trade. And I think that's
sell
an
off an end of
important
day.
part of the near-term market discussion,
Or
because I think it
rally or
means
some
that
kind of
with whales this big pushing this trade
non-chop.
so consistently. They've been doing this throughout the year, and they haven't flinched. They're going to keep doing that, and that's why I think you can see we'll get through 5 on the 10-year, and then 5 1/4, possibly 5 1/2. I'm not sure much beyond that, but I think that is where I think you have to start thinking about that, and that of course spills over into a whole bunch of other topics as well.
Really well said, and love the ranges to think about there where bonds could go. Do think that was a big deal.
So you might be getting
selling off through
you might
some
be
of
getting
these
equity in a new company though.
Risk-off events that
Those barbecue shares were.
bonds. So right now, with the economic surprise just crushing,
You're going to become
expectations,
worthless.
the data beating, and the yield curve
After everything was
steepening, it just
liquidated,
doesn't really
your
happen
only
like
option
this
was
immediately into a
get,
recession. It typically
equity in some other
reflattens. The only
company.
concern that I feel like now that people can argue about the bond market, apart from the carnage
But
it might inflict
it's
on
nice now is you don't have
stocks,
to
which
worry
are
about
very
making any
separate
decisions.
From the economy. The risk, Mike, that I know you
You're
hear too,
in.
which is, well, this isn't such a great steepening. It's term
Can't-
premium.
no
because
reason to
now
close
the
or can't
government is a
close, can't
risk
buy.
itself with all the issuance that they have to deliver. To what degree do you sympathize with that notion? Do you think we have some evidence so far? What is the veracity of that claim that bonds are supply driven, deficit caused, et cetera?
I think you have to tackle that question in two different ways. The one way is there a sort of a credit premium for U.S. paper that today that there wasn't there a couple of years ago because of the higher
Eyes rallying here.
deficits and so forth?
6 minutes to open.
It's very hard to sort of really isolate whether that is being charged. There is an asset class called US CDS there, but it's not really liquid, and I'm not sure it really is too informative.
With that break
there.
above
So I
420.
think it's a little bit more of like, this sort of more of a cocktail party
Yeah, SPY's
discussion
been
than
consolidating.
it is something to trade off. I think
Basically
but
this
if
whole
you
year, right?
are,
Just kinda chopping.
if you look at some of the auctions we've had across the curve over the last
Not
few
really this
weeks,
whole
they
year, I
haven't
guess.
been as
Wow.
robust as they might have been. But does that mean because, oh my God, everyone thinks the U.S. is going to go bankrupt, or is it more that, hey, wait a second, there's a lot of
Oh, yeah, I
there's
gotta
a
zoom
lot of
out.
issuance
Curious how long
coming.
that's taken.
We have a bond market that is going through a massive gyration, and I don't necessarily have to back up the truck on this issuance right now. They're just, sort of common sense blocking and tackling.
Yeah, I mean, it's just setting a downtrend.
Supply-demand dynamics. I think it's much more the latter there.
I know what you mean. We all think, oh, it's just going to crash and keep going, or
the broader
go up to
existential
new highs
questions
or whatever,
about,
but
about the U.S. credit is becoming Argentina style. I think that's really
that just gives us
it's a little bit more
and
abstract.
consolidation and
Abstract
lost
or
year.
fantasy, Mike? How far do you think?
Well,
And it might not be the end. We could have another
that's a whole other
lost year of
conversation
just
topic
trading
all
in some
about-
range.
About is the U.S. reserve currency going to be challenged here by something?
Yeah, you
else?
record
And
with
I
your
think that
brokerage.
something else
You can
is
ask them.
still
It's
very
probably,
much
if you look somewhere on your
maybe it's a
platform,
fantasy,
I'm
maybe it's
assuming there's
sort
a
of vague,
record of what you have
slow
there.
cobbling together, but whatever it is, it's going to take a long time. And let's face it, the euro and the yen have been around for a long time, are the second and third most important currencies after the dollar, and they're still hardly have a chance of becoming something here. So the idea of a BRICS currency coming and emerging is, I think, again, it's more conversation.
It's building a
than-
base
than-
at 420 to
than
me.
any
I mean,
sort of tradable
if it is going to move
reality.
higher and bounce off
With
of
all that
here,
said, I think I have been impressed by gold's
which I think we still could get a Santa rally.
here. We got down to 1816.
I don't see us necessarily breaking this
year.
high.
But that's well above marginal cost of production
I
here.
would be surprised if we did.
And given how strong the
We do
dollar
rally
has
up
been
that-
and how
that
high
much.
real rates have been and continue to tick higher, I think it's a tell that people are.
I still think those
hedging
October
some of this dollar
lows are
risk
gonna be
with-
broken.
With gold
Maybe not
here,
this
that
year,
there-
maybe
there's
not-
a
may
bid
not
for
be till
gold
next year.
Even with U.S. real interest rates being as
That'd
high
be
as they are.
quite the
And I think
crash if we
that's
broke them this year at
important.
this point.
Flip it around.
End of October.
What if real rates started falling quickly, or the euro started climbing quickly, or the yuan?
Yeah,
started
GNS had a
climbing
big
quickly?
pre-market
Would
move.
the
It was up
dollar-
like
would- I'm sorry, would gold be
26%.
at 2,300?
It's just
I think that's
the
an
liquid, I
interesting
guess.
thought exercise to run
Love it.
here.
Mike, great stuff. Exactly what we needed this morning. Fantastic macro analysis to put it into
One's
perspective
fickle.
for us. We got to jump, but it's great to have you on. I'm glad we got you there at the New York Stock Exchange. Mike
Right.
Purvis, CEO of
2
Talbot
minutes.
Capital. His macro analysis has gotten quite fantastic over the years, frankly. Better and better. I think he put everything really well together there for us. When we come back, we do have some
So you'll
stocks
see a
to
line
talk
down
about.
here, 300
The
SPY.
macro today is a little bit quiet. Do like Mike's point there to maybe watch gold. Perhaps that's why gold's been able to shrug off the higher real yields. Some perhaps hedging of treasury supply risk and the ramifications of what
Those
are
lows.
bonds doing right now. And the bonds this morning are, though, a little bit firm. So we don't have too much drama on the macro front. Be right back.
Schwab Bank Investor Checking, the checking account built for investors.
I don't know what line you're talking about. Maybe close to that. Yeah, Yeah, that might be support. I figured this would be kind of that first support, pre-COVID high, then 71, and then maybe even that COVID low we could take out or bounce off. But yeah, that pretty interesting. I don't usually chart in such long time frames. Yeah, no. Yeah, I think so too. I think we're in a chop bear market more or less the next couple years as well. All right, there's the bell. SPY's opening up. Down 0.10. We have a gap up on phase. 25%. He's opening up flat. AMC's down 1%. Wheeler's up 22%. That was a zip pick. Sorry, that was me. Peter wants me to do stuff. Do something. Let's see. West is up 3%. GNS up 3.8. Bag up 4.25. Let's see if I can do market orders today. Probably not. What's up, Maui? Good morning, man. Returns to trends. Yeah, eventually. Long time. Quickly, for sure. I have GNS already. Alright, he's off. Off to the races. Yeah, it's not a bad pickup. Maybe a little inverse head and shoulders there. Maybe making a higher low. Adds up 35%. Oh, snap. Cosmo Kramer. I dance around VWAP. A little VWAP chop. AT&T's up some more. Continuing from earnings. Base up 1.5. Share count. GNS. Yeah, there's new high on SPY. There's a lot of stuff going on with GNS. He's actually seemingly trying to help out the shareholders and his stock from being manipulated via a lot of different avenues, and it's worked. GME up 1.3, yep, 0.85, new high there on SPY. Quarter on AMC. Base come down a little bit. It's up 17 still. 0.8 on GME. AMC 2.8. Back down to VWAP. Ooh, jumpy. I don't think we have much economic data today. Check. So we have Harker. Ed Harker was speaking at 9. He's probably done. Mester speaking at 12:15. Then we have commodity stuff. Just mostly commodities data. I guess Powell didn't really confirm nor deny what the Fed speakers were saying. Have to clean. SPY went green there, I think. Be up 1.7. eBet up 5. Wayfair up 3.5. Ugly chart though. Groupon 3.25. Coinbase 2.8 now. Yeah, Enphase is down 13%. Bottom of my watch list. Crazy. SPY back down to VWAP. A little late, but I'm picking up a couple puts there. I was trying to get on this channel break. See if we break this one and retest the lows. Up and back up to VWAP. Doesn't want it. Hey, liquor's only down 4.8 right now. Imagine that. Thanks, Scats. Yeah, we're doing good, man. I've already heard them talking about Butterfly, that ticker. I wasn't sure if it was that ticker or not, and I looked it up, and I think it was. I didn't read a post about it, but but yeah, maybe. I doubt it, but I think that was already, some people were already speculating on that. I mean, they're talking about what I hear. Talking about the president, or I mean, it's getting pretty crazy now. How far they're going with their tin. Or is it Elon Musk? Or no, it was Eminem. Something about Eminem. I was like, what? Yeah, I listened to some of the show last night. It puts me to sleep sometimes. Today I'm actually wearing a heart rate monitor. I started tracking my heart rate, and just seeing what my heart rate's doing during certain trades, and trying to just collect that data and potentially be able to see when I should enter a trade based on elevated heart rates. That's at least my goal with it, to get some data so that I can help maybe track and prevent poor decisions, that I can actually see. Like, it's good to get in tune with your heart rate, but it's sometimes hard to be paying attention to it. Take a little profit there. Way too choppy. Put a stop on the rest, which will probably get stopped here unless we flush. Yeah, I just got stopped. And now we can flush. Some deep indicators. Yeah, we'll see. I'm curious because I know when I'm gambling, my heart rate's most likely elevated. Sometimes entering a trade, if it's my position sizing is large, my heart rate elevates, which is fine to an extent, and I'll just be able to track all that. So a certain time when I'm entering and exiting trades, hopefully there'll be some data I can see and say, okay, my heart rate wasn't too high here. It was higher, it was elevated, which is natural if you're entering. But if it's too high, maybe it's because I shouldn't have entered, or my position sizing is too large. Yeah, we'll see. I'm just curious on it. If maybe we can help. Here's a little fleshy. Little bit. A little wee bit choppy. Okay. Alley. Back up to VWAP. I'm gonna take trades in a channel. It's got to be on the right side of the channel. They don't like taking trades in the channel though. Oh yeah, I forgot today I'm trading Mondays, so they'll move even slower. Slowly. Okay, let's see. You can't talk on mine until you remove your number from the other? Oh, like another account? I see. Oh, because you can only be verified with one or whatever. Is that because of my security on my server, or is that something else? Doesn't help. I still got all those bots. 2.4 on AMC. I'll grab calls. We break this channel. Puts maybe the top of the channel potentially. I'm missing another setup like this though. So let's see. I'm chopping around here at this point, but it's just way too soon for that. Yeah, so it's a different account. That makes sense. So I've got buying power for maybe 2 contracts. Let's see. Yeah, maybe probably 2 contracts. Depends on how close they are to the money. Right at the money, probably 2 on the 0 day. So I'll try and wait for the best setup for that. And then other trading account, probably 1 contract. Of course, if I'm not over trading, I'm doing much better and having more success. Safe. Fisker. Pretty choppy this morning still. Vision on today yet. Yeah, 0 days today. I think we'll have to protect him and get him profitable and get out. I don't think we'll have a whole lot of continuation today. I don't know though, it is OPEX and maybe end of day. % on AMC. Friday it's up 45. At GME holding 1.6. Ends up 4.8. Oh yeah, that's right. Crypto is rallying. Bitcoin's up 3. Ether's up 3.5. They're both up 3.5. That because that ETF or whatever. GNS down 0.8 now. Chop, chop, chop.
all that energy coming to the market associated with AI and the real tech run-up that we saw into those highs, and you can see how basically we've been in a range since. So again, just kind of working our way through the middle of it, very random, limited in terms of real conviction.
Let's talk that WTI, because $90, you know, when crude broke down from 95, that was such a harsh, fast move. It looked like it validated some of the crude bears case that there's a cap on how far that can go, with maybe a little bit of economic question around the world on the demand side, still supplies we've seen from some inventories. But when we get back to 90, it feels like we should have that conversation again about maybe what's possible to the upside.
Oh, absolutely, because when you're talking about higher crude prices, you're talking about a headwind for stocks, and you're talking about a further complex situation for Fed Chair Jerome Powell and the Fed to deal with. Now, we were just looking at a contained market in terms of the S&Ps, and one could argue a very similar pattern playing out here in terms of crude. We did see that spike, as Oliver mentioned, recently up to 95. You'll notice that that also coincides with the fall highs from last year. So there was a bit of a double top on the left side of your screen as well, up around October, November of last year, up around 95. And then kind of getting back to what Oliver was talking about, that big spike lower that we saw back down to 80, that coincided with the big move that we saw in yields. They were spiking, and that raised some demand concerns. Here we have the war on Israel coming back into play, the conflict in the Middle East, and that's got prices back into the middle of the range, basically. Now, again, relatively muted and tame. Considering what could be playing out, I've been hearing a lot about how this is tied to involvement in Iran or lack thereof at this point, and more so supplies through the Straits of Hormuz, and how that could be a real issue if that becomes a problem in the coming weeks, Oliver. Something to keep an eye on. We know geopolitics keeps prices elevated at this point. What we're waiting to see is, do we get a spike out of this range at this point? That'd
something
be
like
concerning.
what we got for like Russia, Ukraine style.
Sure, up
so
to 130,
far, yeah, so far it hasn't quite been like that.
Which is a good thing.
For reasons you described pretty well there. It hasn't boiled over into some of the kind of tail risk geopolitics just yet.
Absolutely. So again, with the S&Ps kind of hanging out at this, well, just below 4,400, below 43 now, it's still in this range.
New low there on SPY.
What's going to be that tipping factor to kind of send things one way or the other? Obviously, crude above 95 would be a bit concerning, but we've also been keeping a close eye on the dollar, which has had a very level-headed approach towards all of this. Dollar hanging
testing
out
low,
right around
pre-market low right here.
And well, you can see just below
just
today
flush
now,
through
not really showing the same enthusiasm to the upside that we've seen in rates, but I think this kind of ties back to that
I had
energy
a better entry on those
well,
puts.
Probably
Remember, gonna stop. Well, I probably still would have. That was a pretty big spike.
The U.S. dollar last year, when we were topping out 113, 114, coincided with a weakening euro currency associated with energy concerns with the war on Ukraine and natural gas uncertainty in terms of what it would create for the situation for Europe. Higher natural gas prices, when they need it in the winter, ultimately is going to weigh on the demand or their economy, and really the pinch that they could have dealt with associated with the Ukraine war. Now, we're dealing with that in a very similar fashion. That's why I say look at the dollar. If we were to see the euro currency start to weaken, if the war in the Middle East were to worsen, that 21-mile channel, the Straits of Hormuz, it travels a fifth of the world's petrol flows through it, and we're talking about roughly 18, almost 20% of natural gas shipments go through there. So if we get a disruption there, we could see the euro currency start to weaken again, which is what bolstered the U.S. dollar last year. Ultimately, I think that would tip the scales one way or the other in terms of stocks. That strong U.S. dollar, definitely a headwind for the Dow. We saw that a little while ago as it came off these lows here recently. That's what started to tip the scales off the highs for the Dow. The multinationals definitely deal with that as a headwind.
Breaking out of that channel.
I think that it could become a bit more of a problem for stocks if this dollar starts to accelerate, if the energy crisis becomes worse, and again, kind of tying in natural gas prices to the euro currency, but ultimately the dollar being the one that gets pushed one way or the other as a result.
Well, it's a good reminder that we need to be watching natural gas too, because of the regional specifics about where all that flows through. So it's a good look here at not just WTI, but how it connects into possibly
down 0.5%.
Our typical risk-off signal, which is higher dollar, but it hasn't really been playing out that way. So it's a good thought to connect that to us to watch right now. Gold is up alongside crude, so you're getting a little bit of a safety bid there, but the dollar's still red on the day. Stock's not too far off, but about 0.5% down. Let's talk about NVIDIA. Alex Coffey joining us, host of Next Gen, for a look at the analyst note out that is adding on to some other, not bearishness this week, Alex, but a few reduced expectations we've seen.
Yeah, I would say modest decline in optimism in NVIDIA, but really quite optimistic still when we get into some of the numbers. Today, this morning, NVIDIA bucking off.
Thanks, guys, for your thumbs
weakness that
up. I
we're seeing
appreciate
in the
it.
overall market
17,
is,
well
really,
done.
the screen's starting to light up in the last 10 minutes with the S&P is now down 22. NVIDIA is still up 45 cents, so just above the unchanged line. Up about 0.1% as we speak right now. KeyBank analyst John Vin lowering the price target to $650 from $750. Oliver still implying $230 in upside from here on a $420 stock, so over 50%, and a stock that I think you could make an argument that many would agree with. This is the stock of 2023. It's up over the last 52 weeks, nearly 250%. Year to date, it's 188%. Only about 16% off its highs and what seems like a pretty substantial decline off of 500. But when you put in perspective the move over the last year, it's relatively modest. They do keep an overweight rating on the shares. Broad-based demand, they say, in terms of trends, remained weak. They see China showing limited signs of recovery, but they do say end demand is not getting meaningfully weaker. When you compare this to the overall street stance on this stock, 60 of 63 in buy, the other 3 in hold, so no outright sells. The average price target, at least in terms of what Bloomberg's watching over the next 12 months, is 649.70. So let's call it 650. So
You're
right
low there
in
on SPY.
line with what John Vin at KeyBank is saying. We did get a neutral rating out of Edgewater Research today. Wolf Research keeps their outperform as of yesterday with the 630 price target. Oliver, never in good conscience could I suggest that a stock that's up nearly 250% from its lows and over the last year could be considered, undervalued. But you could listen to the logic on a blended forward PE. This thing's sub 30 now. Over the last year and really the last couple years, it's been in the kind of low 40s in that metric. So this pullback really has changed the dynamic. Granted, the whole AI bubblish-like activity that's really driven so much of the revenue growth for NVIDIA, the question's going to remain, is that here to stay? How sustainable is that growth trajectory? One could argue probably not very, but even if it just holds steady, the amount of revenue that was generating for NVIDIA over the last couple quarters has been astronomical.
Really well said, and I think the proof is in the pudding of what you're saying basically about valuation, and the pudding in this case being the market action. Because the easiest explanation for why stocks have pulled back for 3 months is that rates blew out, changed the valuation math for stocks, and so those stocks that got hit probably, we have to say, were too expensive relative to the bond market in this case. But since NVIDIA still has not made a single lower low, and it was just at a high in late August, to your point there, that seemingly is the market telling us that it's actually not that bad of a deal if it lives up to all these expectations, because that's what the valuation's riding on, right? If there were a guidance cut or something, it would be very, 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 very bad for this stock.
I think that's well put, Oliver. I mean, so much of these expectations have been simply because NVIDIA has just said we're going to meet these numbers, and then not only did they do that last quarter, they exceeded what seemed like just an untouchable guidance from the quarter before, and then did it again. And so I guess the only concern that I saw is that it wasn't able to kind of sustain the excitement. There's some really, really high price targets on this thing. It's had a really, really nice year. You can see that chart there, that first gap up 2 quarters ago around earnings. We don't hear from them again for about a month. I think it's November 21st is the earnings date, Oliver. So a lot can change between now and then. But I guess the one concern from a charting standpoint is if it does break below, I think it's around like 360, 370, where that gap up is, there's just not a lot of price activity. Could be a lookout below, but quite frankly, that's a long ways below where we're currently at.
Okay. All right, so I'm also kind of surprised that the shares have not done worse around some of these analyst price target cuts, actually, because even though they are hyper bullish, and one could definitely argue me on this because the price target's at 650 from this particular analyst, we're at 420. It's a massive move. usually it's like, uncouth to even have price targets like that high above a stock, but that's kind of like the standard at this point. But on the margin, the fact that everybody ramped up all these price targets, the fact that they're bringing them down a little bit, I guess it's not quite as priced out as I thought maybe it would be. I thought it might be a little bit of a surprise, but okay, I guess analysts are retooling a bit, and the market is saying, look, 650, 750, potato. It's still a long ways away from here.
Yeah, I think so. I think also too, Oliver, the market's come down. Like Nvidia can still be an outperformer. It can still put up, these robust numbers. But if the whole sentiment in the market starts to crack a little bit, that's going to impact even your best performing stocks. And so, you can almost lead that to be the greatest reason why Nvidia has come from 500 down to this 419, 420 level. It's an $80 decline in the stock. That's what? 20% decline nearly in the $500 stock. So you start looking at that and say, what did Nvidia necessarily do? Well, it's not really that Nvidia has done anything. If anything, it's actually made it more attractive. But the overall market really complicates things. And you talked about how much yields have impacted that.
Yeah, definitely. All right. So they really need to show fissures in their actual expectations and guidance for, it seems, this to be a disappointment.
If we can get
right now,
entry on some puts.
Still a well-supported stock. Price targets, even when they get shaved down, still far, far away.
I like the top of this channel, or VWAP.
Shares, hey, 420, still above where they were last month, which is above where they were at the August lows, even after the U.S.-China stuff. So it's held in there.
But let's see, maybe it could just come up here and chop.
Definitely, though, worth thinking about, even though it's still some time away, those earnings. Let's bring in Dan Deming and do some trading. He's managing partner at KKM Financial. All right, Dan, it's a Friday, so let's trade the big winner on the year, and it actually just flipped positive as we speak for the day.
Yeah. Yeah, Oliver. Yeah, it's hanging in there today. Yeah, even with the selling pressure, we're seeing Nvidia hold this 420 to trading 423 right now. The one thing I'm looking at, and Alex brought this up, I mean, some of the technical levels, when you look at this stock going back over the last couple of months, and to me, it looks like 400 is some pretty meaningful support. But then after that, it does become a pretty substantial air pocket. But by and large, it's held this 400 level a couple of times in the last couple of months, Oliver. And I think if we continue to see some sideways price action before earnings, that there's another opportunity here to maybe collect some premium and see how this plays out over the next month, and then have the opportunity to get put in a stock at a better level. So today's trade example is selling a put spread below the market.
Okay. So how far below? Where do you need to go?
Bullish trades on Nvidia.
Yeah, so I'm looking at the 400 strike.
AMC
so
below
in this
VWAP.
case, I'm looking at the November expiry. Well, so we're 28 days out from that, and so that's before the earnings announcement. And I'm looking at the selling the 400 put and buying a 350 put to cover some of the cash that you're going to have to outlay. I don't want to have just the cash secured put out there in this trade example. So looking at selling the 400 350 put spread, you can sell for about $8 here, a little less than that maybe now with the stock ticking up a little bit, but somewhere around the $8 level. And with that, you're collecting $2 versus the stock. You're collecting $8 over the next 28 days. And that's a pretty, I think, decent return profile with the opportunity to get put in the stock if we trade below 400 at expiration. And that's a level I think that's worth picking up the stock. So really you'd be picking up the stock at 392 in this trade example. Again, have the opportunity to collect some premium, see how this plays out, and be out of that position technically, or either in the stock before the earnings announcement.
I feel like this trade is
You're low there on SPY.
Makes most sense when it's in the number one, stock of the year, basically, because the odds that you're just going to get to collect this credit and keep it are pretty high. And then if you don't, all right, so now you own a stock that, people are going to be, scrambling to buy on dips. NVIDIA hasn't had a real dip since this whole thing began. I mean, we've had a few shake-offs here and there of the excess maybe, but we haven't had a real dip in this thing. So if it does, come on, it's not just going to go straight down unless it's the world's worst earnings report.
Well, exactly. And the other thing is, Oliver, if you look at the margins, you look at some of the metrics within the market itself, their positioning moving forward, the evolution of the AI space, yes, they've come off the frothy levels that we did see earlier this fall or late summer. But again, just the general metrics as far as from a fundamental standpoint, you still think that if the market holds together, if we continue to see some further upside in the equity markets after settling off some of the interest rate concerns and the geopolitical concerns, that NVIDIA should technically be one of the leaders in that realm. And so there's a fairly decent probability, I think, that we're going to continue to see upside if we see the equity markets maintain either sideways price action or some higher price action.
Okay, nice. Thanks, Dan Deming.
He almost had a straight.
Hoping it doesn't get there.
Wow, he went in so heavy with 6-7 offsuit.
That's right.
All right, thanks. Dan's managing partner.
Playing just like Rampage. It's like his
update for you.
avatar.
Positive, so did the dollar, and equities coming
down more there. It's just
still watching the
pullback was not adequate for me. I don't like that.
A little bit ugly here. Stocks taking a bit of a bigger hit
little
now.
bear flag.
Russell lower by about 0.7%. As I mentioned, dollar positive. Bonds are still bid too, so it's a little bit of a different type of risk off today. We're going to keep talking big tech though when we come back. The mega caps will be in focus because we only got really one so far. Tesla.
Chips back.
Not sure if Netflix really counts. Under 200 billion now.
What the heck? That's alright. Wow, I'm getting some hands. I'm gonna bluff it. Oh, I got a full house. Oh my gosh, poor person. That's like the third buy-in since I've gotten here on the last 3 hands. 3 hands, 3 buy-ins. Problem. All in. Dude, I'm gonna take all our chips again. Watch. Clubs out there. I mean, there's a straight. There's clubs. She did have the ace at least. That's good. Yeah. I should leave. Alright, Spy, come on, let's see it. I'll be ready.
pretty clear. Like if they beat estimates or raise guidance, not a bad time to be going in as an investor, because what happens thereafter? All the analysts have to catch up, hold to buys or buy to strong buys, $80 price targets, now 120. So again, that's the way we like to approach. Wait for them to post earnings, hopefully beat, hopefully raise guidance, and those are the ones you want to run with.
Does the optimism extend, Ken, to those stocks whose valuations have grown or have made it to records or highs, or next to bonds have gotten expensive now that we've got some competition for yield?
I think so. Look, we're growth managers, so we'd stay far away from airlines and autos and retailers and kind of come to those seven, so to speak. And what really stuck out for us was Microsoft last quarter. Good numbers, beat estimates, raised guidance, but they weren't they weren't running into AI as fast as the market would like. I mean, on these conference calls, I heard in the video say the word
Full
AI,
house, dude didn't do anything.
90 times. Microsoft said, "Hey, it's going to take some time to
He's hoping I
transition
would
and
go all in on the
maybe some
river.
cost." The market didn't like that, but by the way,
Asymmetrical
Microsoft
double tits algo precursor to
season,
flush.
and now we're
Is that
looking
what
at this
that
earnings
is?
season where look, you still get all the great verticals from Microsoft, right? You get gaming, and you get cloud, you get network and security, and all those type of things, and Windows and everything. And so, hopefully the sum of the parts bring the whole. So we're hoping Microsoft, all those seven, have the best room to run, because that's the one that hit the hardest, and over AI for that matter.
Yeah, it's been a year since ChatGPT debuted, and with the big investment they've got into OpenAI, do you think it's time for them to start reporting some numbers, get a little bit louder than they have been with all the spotlight, hogged by NVIDIA? Time for Microsoft to step it up?
I think so. I mean, look, last earnings period when the video went crazy, we were saying the word AI, artificial intelligence, equal about $10 billion of market cap. Hint, Microsoft. So if you at least say it 10 or 15 times through the earnings, again, you got to do what's right. But, they're just kind of coming in a little bit. So, but look at how many customers they have, how they can cross-sell, how they can upsell all their customers to join AI. So of all the different companies, I think Microsoft is one of the best positioned here, especially coming down so much. You notice, though, the last, your chart there, the last couple of weeks, even though the market's been pretty ugly, it's trick-or-treat season, right? Microsoft seems to be making a rounding base there for those technicians that love this stuff. So I think combination, mostly the are very strong, but then we got some technicals helping out as well.
No, that's a really good point. I was just looking at the same thing, that 310 basically that we bounced off last month.
Yeah, double bottom.
Exactly, which is exactly where we hit in August, which is basically the top up of the gap up from May with all the AI stuff. So we've held the levels that we need to hold for a stock like Microsoft. One last thought on Microsoft, Ken, as the Activision deal gets done. Do you think that was big for them? It didn't seem like it was a big mover ever for the stock, but I just feel like it's still such a underappreciated story. As as a video gamer, as a follower of the stock, it's a big deal.
It is, but it's accretive to earnings. That's all you're looking for. I mean, a lot of these deals are not accretive, and they pay off 5 years from now or 7 years from now, and they play around estimates. I mean, day one, this is accretive to earnings. So look at these type of deals. This is what Microsoft does.
Okay, all right. So we'll be looking for that too. What about Apple, the safety trade, if you will, Ken? Just incredible the way Apple powered back, made it to the highs. And then since then, though, things have gotten a little bit choppy here. Some pretty consistent lower lows, lower highs off the top. But again, we're still above $170. This thing was like more reliable than bonds for much of the past year.
I think it will still be reliable. I mean, look, tell me a company has 2 billion customers. It's 2 billion. I don't know what's on earth now, 6, 7 billion. I don't know what the number is. 2 billion, okay? 1 billion, or half of that 2 billion, are having some type of Apple service, the different things they put out there. So I still think this company still has a lot of potential, still sitting a lot of cash. Cash was nothing, right? But now you're getting 5% on cash. And again, I think the expectations were very high about the iPhone 15 rollout.
Oh, he did have it.
Remember,
Nice.
Tim Cook did a nice job
that
pivoting
played
from
out
a
well.
hardware company to a software company to a service company, for which they are now. So I still see a lot of upside. It may not be a barn burner, but let's not count out Apple. Look, the 2 billion customers, Oliver, if they had something tomorrow that connected to your
bet too
nose,
big
your
on that.
ear, there's
Wow.
$10 billion that just drops to the bottom line because they have so much control, so much of the market.
Yeah, absolutely. Are you worried at all about how the holiday season for spending goes, or have all the data told us that people are not going to hesitate to drop $1,300 on a new phone?
Yeah, that's interesting. Our study showed that there's 25% of users that have a phone 4 years or longer. Now, if you have a phone that's 4 years or older, guess what? Your battery probably doesn't work. The apps don't run. You're almost forced into an upgrade. So you know what? Christmas season, Santa Claus coming around, putting some stockings in. I think it's a good bet because, like you said, there's a lot of people with outdated phones, can't keep up with the apps, the phones don't work well, and what a great gift idea for those who have everything anyway to upgrade upgrade their phones.
Yeah. Hey, one other part of tech I know you watch, Ken, and I want to end on this, but it is important, not as big from a market cap, but some of the cloud companies that have been making fresh one-year highs. We just got it for CrowdStrike a couple days ago. We got an upgrade yesterday from an analyst on Zscaler. I mean, these companies are in the category of still far below COVID highs, but showing pretty good momentum at the moment. What do you think is possible for those types of stocks that were COVID heroes and then got real hit hard over the last 2 years?
Right, but now we're starting to see multiples expand because the cloud. There's a lot of competition in cloud, but there's also a lot of great services there. So I would say the bats again, they are speculative. But look, I do believe growth over value. We've seen that for some time. These companies are going to start growing the top line, and we'll watch it during earnings season, Oliver. They can actually beat and raise guidance, and even though they look expensive, multiples will expand if they can beat guidance, and that's what we look for as growth money managers.
All right, Ken, good convo and a great setup for us, a baseline for our tech thinking next week. Appreciate you joining us.
Right. Yeah, thank you.
You got it, Ken Mahoney, president at Mahoney Asset Management. Coming up, let's also talk about Boeing, General Electric, and Coke, because we all got earnings coming up. Some of these charts are pretty fun, too. You kind of know the story for Coke already. Punished alongside the other, I don't want to call them unhealthy stocks. Maybe they are, maybe they're not. Depends which Coke you drink. But they all got Ozempic. And then Boeing had a nice little highlight over the past week with its Spirit deal, but shares have still been struggling. And then the unlikely winner, the unsuspected hero of 2023, General Electric, coming back with some charts.
Alright, SPY. Little bounce here on SPY. Waiting for a break of this channel. Go long. And to go short. Distance on that channel. With some maybe channel breaks. We'll see. Head and Shoulders or something.
We've seen nothing but weakness, and shares have underperformed the market by a pretty sizable margin now in 2023, falling about 17% through mid-October versus the S&P 500's rally. Now, much of the gap can be, again, attributed to this single metric being sales volume. They did report flat volume last quarter, meaning all their growth did just come from price increases. And while that performance is good news because it does demonstrate pricing power, it also does raise the big concern among investors. If they can't keep relying on price increases, then sort of like what does then your quarterly earnings and your overall picture look like now going forward? So investors, I think, will want any progress on volume, because if you continue to see flat or declining volume, that's a big problem.
It's a very good point.
These spike make back the view up.
Say that the Ozempic narrative, maybe it was just overdue for a reason to drop because the fundamentals are just not that impressive.
Right. I feel like we were looking for an excuse, and the Ozempic narrative came in the right time. But even Rick and I looked at some of the numbers of Ozempic. There's not concrete data about how much this is impacting the average American yet.
Yeah, the market just kind of freaked out. But when there's not a lot of growth anyway here, you know, maybe it was just, you know, a coincidence that this narrative kind of broke the stock, because it did kind of develop that way, Rick. I mean, it was well supported for a while, going nowhere, and then just kind of snapped.
Very well supported. We had this kind of, we talked about this yesterday, kind of an M-shaped pattern here. You can see we topped out twice just below 65. 64.99 was our high point. Could not crack above that 65 level. But you can see this area right here, right around 59. 58.86 is where we bottomed out numerous times here. That was the low point of our M. Further time we bottomed out there right here, but you know, once we started getting below this area, things started to kind of fall apart here. We had a steep drop off from that point, another steep drop off. If you look right here, we had a big red candle here once we broke below our old previous lows from 54.39. That's why it's worth keeping track of these things, because the reactions can be energetic here. Since then, we're down like 15% from those yearly highs. Not terrible, not the worst move we've ever seen, but for a staples stock, that's a big fall off.
This is a beauty of a chart, frankly, right? Because like it's kind of textbook, especially the way it started slipping before the real collapse. I mean, all that support carved out, well defined, a line that you would have even had going into it, and then you lose it, and then bam, everything falls apart. I mean, this is like exactly when to trade a break of support or a break of resistance.
Yeah, definitely here. And, you know, coming up against resistance once again today, even though we did recapture this area near 54.40 or so, we're not able to clear our yellow 21-day exponential moving average today. And the one thing is that the moving average itself starting to moderate a little bit. We were trending downward steeply. It's starting to flatten a little bit. That's a sign of some improvement here. But overall, price below all three moving averages. The moving averages are trending downward here. Momentum improving a little bit. We were deeply in the oversold area, but we've managed to kind of fight our way out of it here with one more dip back below it before we eventually climbed out. But we're still short. We're still short of the 50 midline here. Still bearish momentum. Couple that with a failure to cross above our 21-day EMA. Not really the greatest picture here, and our trend is down overall too. So trend is down, momentum's bearish, and we're not crossing above resistance here. If we were to cross above resistance, we've kind of got these two competing trend lines here. Medium-term downward trend, shorter-term upward trend. If we were to break above that trend line, we've got a little bit of a volume node right here near 56. Obviously, you can see so much of the trading is up in this range above here before, but 63-day EMA near 57, that's another point to watch. To the downside, the old lows near 51.55 is the final line in the sand.
It definitely seems like the chart suggests that this could stay a fairly volatile stock, because the support and the resistance, once you get away from like the very
bigger pullback up here, so
there's a good
didn't get it, so it's a smaller position size.
Areas. So, all right, that's a fun one. Let's talk Boeing. Shares have been not doing great, and then they essentially kind of had to bail out their supplier, Spirit AeroSystems. What are we looking for in this report, Jenny?
Right, so we saw, I mean, that move on Wednesday in Spirit Systems was phenomenal, but Boeing didn't really move because, again, I don't think Boeing is the beneficiary of that deal. They basically just said they're stepping in and they're going to ease some of
they
these.
get the parts, but like...
Right, but it doesn't necessarily mean... I tried to see would this be any benefit to Boeing, and actually we could see some price decreases of some of their 787 airline jets, but with some of these parts and the restructuring with Spirit Air. So I didn't see that actually as a win. I saw that as a negative for Boeing, but expected to post a quarterly loss of $2.89 per share in their upcoming quarterly report. That's Wednesday before the market opens. This represents a year-over-year increase, though, of 57%. So even though we're expected to post a loss, that's actually some significant growth. Revenues are also expected to be around $8.5 billion. That's up almost 16% on a year-over-year basis. Amazing to me about Boeing is that with the missteps they've had that have been very public, very discussed, this name has 19 buys, 9 holds, no underperforms, no sells. And the average price target at around $246 implies, I mean, over 35% upside from where we're currently trading.
Wow.
So
even with all those holds in there, the average price target's that far above, so the holds are kind of bullish too.
Right. So I mean, the skew on this name is still overly optimistic for a stock that has been really retreating ever since touching 52-week highs at around 243. So that's not even, it's beneath the average price target, which is wild to me.
Yeah, really good look here at some of the action that has been happening, and also, you know, their complicated supply chain problems. This weird chart, Rick, it's like we got one
just
chart
ticked a
here,
new
and we
low
got another
there.
chart here.
Yeah, kind of to borrow an airplane term, a holding pattern for a while here for much of 2023 between about 193 and 221. Earnings gave us a big boost, you know, pushing us
close
above
on there.
that resistance
That was
line
slow on
into new
Fidelity.
yearly highs near 243, but it was not to be. The trading gods are cruel. We had a bit of a rug pull here. You know, we gave back all those gains and even more. You know, a big downward channel here.
That was a sick move.
Yeah, I mean, it's you know, it's it never stops hurting. You know, you never get used to stuff like that happening to you. But
Mara,
you know,
Riot,
we fell
yeah.
downward a little bit here. We crossed below the old lows from our range near 193. Now we're kind
Pizza
of
Party Friday, maybe, I don't know.
right at these lows right
We're
here, near
fancy.
about 182.50 or so. So you know, that would be another point to be on the lookout for.
Maybe
In
double
trading
bottom
today
down here.
But moving averages all trending down, price below all three. The fastest
price
crossing
action
below
is
the slower.
like
We're about to
molasses.
have another faster crossing below slower one here with our 63 and 252, sometimes called the death cross. Not the greatest trading signal, but an important indicator that the trend is continuing to deteriorate here to the downside. Once again, a crossover into the oversold area. Good reminder here too that stocks can remain oversold or overbought for long periods of time. You know, you shouldn't be looking at this with the idea that once it's oversold, it's going to bounce for sure. That's definitely not how it works. You know, it can be oversold for long periods here, but typically regarded as a sign of weakness, especially would be so if we were to break below this support level near 182.50. Volume nodes here near about 175 and 185 or so. Those are some potential
already to
congestion
200.
areas to watch as well.
Okay, seems like Boeing desperately needs to hold that 181 there.
Pretty far down there
'cause,
still.
Man, what a rollover, what a fake out, what a rug pull on that. Okay, last one. No rugs pulled just yet on General Electric, but I don't know how many people have even noticed how well the stock has done, Jenny.
I don't either. And actually, this one is the most interesting to me because it actually will be expected to be beneficial from a lot of the same tailwinds for a name like
kicker I
Boeing.
have here.
Their aerospace segment is actually one of their brightest spots, including the significant growth they've seen in their LEAP engine deliveries, as well as growth in their commercial services
Nice calling
businesses,
also.
which also then speak to some of their defense
Yeah,
engine
my
supply
kicker got
needs.
me.
So all in all, the third quarter, we are expecting that segment specifically to indicate around a 17.5% jump as far as sales from last year. That's their brightest spot. For the quarter that's going to be reported also on Tuesday before the market opens, Street is expecting adjusted earnings to also increase 60% on a year-over-year basis. So some healthy growth for both Boeing and GE.
Earnings 60%?
Yes, adjusted earnings expected to rise 60% on a year-over-year basis.
Wow.
That's pretty good for a Dow company.
Yeah.
But
There you
I
go,
think
new
in
low
the
there on
eventually
SPY.
You're going to make a Dow comment.
I mean,
next gen.
You just can't expect the same growth. But okay, raw material costs is a concern. Inflation in that area is expected to be a pretty major headwind, as well as Forex is expected to weigh on their top line now in the to-be-recorded quarter. So don't get too excited, because while earnings are expected to grow, revenue overall is expected to decline about 18.7% from last year. So some top-line weakness.
Little catch there.
Yeah.
Okay.
Dow.
But right, okay. So GE, I mean, it looks now, when we look at the line chart with the shaded graph, it's just like up and away. Now we've got the candles up here, Rick. There's a little bit of fall from grace, maybe.
A little bit.
Oh, I got
kind
a
of,
straight.
Mini M pad, a lowercase m, if you will.
Probably has
here.
one too.
But you can just looking at the general shape, you can see we've almost doubled from about a year ago here, trending
Higher
upward very
straights.
strongly, but then kind of trailed off a little bit here. We weren't able to break above those highs near 118 here. And if you look at RSI, it reflects that. You can see this downward
one
sloping
contract
trend
there.
line, bearish divergence as price continued to rise. RSI fell off notably here. Now we're in bearish territory for the RSI here. So look to see if we can break that trend line. And I want to zoom in a little bit on this chart, because there's a lot going on here. We've got a lot of horizontal levels to watch here. So you can see here, we slipped below this 107 mark. That was a frequent stopping point for price, this green line right here. You can see as well our moving averages, another bearish crossover here between our 21 and 63-day EMAs. And we're slipping here today. We're making lows beyond our previous lows from late September here. If we do keep going downward, 102.63 or so represents the lows from back there. And if we were to move to the upside, 110, confluence of bottoming points in the stock price here with our 21-day EMA lining up right at the same point.
Going to be an important earnings to see which
Better
trend it
stop
goes
on the
with.
rest.
Now that we get a lot of that story, I think, has been understood about cleaning up the bottom line, but still no top line
Don't
growth.
stop me out again.
Good stuff and good setup. Interesting companies for sure, even in the Dow.
GME kind of moving up.
When we come back,
Oh.
going to get an update on the regional banks as
Hi.
Regions continues to get hit.
I going for the stop out. And it's successful. Yeah, up 2% there. AMC up 3.3. Getting a little RSI divergence down here. On less buy. And also see this bottom is kind of starting to round. Don't like the risk to reward to the downside, but could be some more downside still. Just when it stops me out like that. Bugger. Table. How slow this thing is moving. Wow. And 47. You guys are having a good morning. 20 likes, well done. Not bad for Friday. Gotta remember these are Friday's contract or Monday's contracts, so a little slower. All right. Might start adding the calls a little early. I don't know. That last little tiny move. Might not be last. Still. New lows, I suppose. Didn't quite hit the 200. Or even that low from the other day. No, I guess, yeah. Oh, I'm thinking this one. Everybody wins. We're closer to power hour. Keep it hot, hot, hot. 20% account profit requirements? Oh my gosh. I'm on a losing streak. My winning streak turned into a losing streak. Kind of how it works though, isn't it? Have a red day and then lose confidence. Try and make back the gains, which I really didn't feel like I was doing. And yesterday was a special day. I wouldn't have been red, honestly. It was the PAL. It was that like little flash crash. Should have had. Yeah, I shouldn't have had those stops on there. I think yesterday would have been fine. So I'm giving myself a mulligan for yesterday. I was excited for today. Be fresh and exercise patience. No big crazy catalyst for crazy stuff. I'm doing well. Sort of. Yeah, no, I am. I'm pleased. Did get stopped out on this little drop here, but no problem. I catch on the way up. What in the world? He still would have beat me? That kicker.
That regional bank got slammed because they had to pay more on those deposits after what happened earlier this year. You know, if you're not a giant in banks right now, it seems like you've still got a pretty tough go of it. Should that worry us?
Well, I think from the regional standpoint, yeah. I mean, if you look at JP Morgan, that stock is actually performing well this year, considering what's going on with the yield curve. But then you got to think about deposits. They are the largest source of
AMC
funding
new high
for
there.
any bank, especially the commercial banks, and very
GME's
sensitive in the regional bank space because their deposit costs are a little bit higher than the larger money center banks like Citi, Wells, Bank of America, and such. So I think this is to be expected. I think there's constrictive activity in yields. Just because yields rise doesn't necessarily mean more loans are keeping up with the effectively the needs to pay depositors a premium to keep their money in that bank. So I think this is a situation where the financials are stuck, to be honest with you. I'm a little bit concerned about the regionals, and particularly if you look at companies like Zions Bank, for instance. Even Bank of America alluded to this in their conference call with the commercial real estate exposure they have. So I think that's what you have to keep in mind for the regionals: commercial real estate, business loans, and effectively a little bit higher cost of funding for these regionals versus the money centers.
Okay, good points. Market is not crazy about any banks really today, even JP Morgan getting hit, but actually the worst part of the sell-off is in tech. Scott Durfee, we got whole group down. Tesla 2 days in a row now. A few that were positive this morning have slipped red. Bonds are bid, so it's certainly a different type of sell-off we're getting today than the yield-driven ones of recent.
Yeah, there's no doubt, and this is just kind of what apropos in line with some of the stuff that we've been seeing and maybe can continue to expect to see for a minute. We'll just have to kind of see how it goes. But, a lot of this has to do with earnings and a lot of other stuff.
We see a lot of
companies that are reporting earnings that are beat both on the top and the bottom lines, but it doesn't seem to be helping the stock market right now. This typically earnings can often be one of the catalysts for, stocks to trade higher. But when we have bond yields doing what they're doing now, pressing even higher, a little bit of a pullback momentarily here, but that's not going to probably hold. Conflict in the Middle East has intensified and threatens to continue to do that. We still don't have a Speaker of the House, and so there's just so much uncertainty that Powell doubling down on the Fed's higher for longer stance. All of this comes into play here, and it's really disconcerting to the average investor and trader in the markets. So, we see a flight to safety, and this is what we expect when we see those things.
Yeah, you're right. Gold catching the bid today. VIX up too, so it does look like it's a pretty sound risk-off trade. Got the weekend ahead too. Whenever there's geopolitical stuff raging, there's always that kind of argument that people don't want to be super long into the weekend. 3 weeks of upside, and the NASDAQ gonna end here. Good stat there, team, that we had in the lower third. Appreciate Scott Durfee and George Tillis. It's it for Morning Trade Live.
Right on 0.9%.
360, hosted by
They might be ready to flush.
Caroline Woods is coming up next. We'll see you this afternoon, 2 p.m.
I grabbed it here, didn't give us the flush, just dropped a little bit and then chopped. It's not giving nice price action at all. This table's been killing it for me. Yeah, AMC and GME both holding up pretty well. 42% on the week for my SPY trades. I think, I don't know. You may be able to do that on other brokerages. Hundreds of trades. You're doing a lot more than you realized. Sounds like you're overtrading. Oh no, I'm still up on the week. I'm pretty certain by a pretty good amount. My Wednesday was... Wednesday? No, Tuesday was really good. Monday was pretty good. Or was that last week? I don't know. I'll check. Yeah, I'm going to move, once I have cash in my trading account, I think I'm going to move my long-term over to Webull. Just don't want to do anything with Fidelity anymore. So I'll get a little more familiar with it. I like how Webull's constantly like updating and adding stuff, and
climbed 13% on a year-over-year basis.
It's like the Tesla of the brokerages.
It was a huge beat by any means, but also profit topped expectations.
Probably even more so than Robinhood, I feel like. As far as like updates.
Record. Total card member spending climbed.
I don't know. I haven't looked at Robinhood in a while, I guess.
420 billion on a currency adjusted basis. In the U.S. specifically, card spending climbed 9% year over year, while internationals did see around a 15% increase in spending after adjusting for currency. They noted that households and businesses have not lost their propensity to spend among going out with travel and entertainment.
I'm gonna make one trade. It's gonna be big.
Restaurant spending also aid that
maybe it'll be
segment,
more than
rising
one.
around 13%.
But
they're
I
also
want the
optimistic
upside.
about their continued ability to court some of these younger clients, saying that millennial and Gen Z customers are now their fastest growing demographic, spending up to 18% year over year, and now accounting for around 60% of their new accounts. So maybe that is the concern, is that when you have this younger demographic that's growing so rapidly, maybe right now they don't actually have the funds to support the credit that they're spending on. Maybe that's the argument, but all in all, a strong report, and I would say solid growth on a year-over-year basis for a company that should be a better barometer of the overall consumer health, but that was not reflected in this result.
Although American Express is higher end consumer, right? So I
just
guess
folded.
that's a
No,
good read
dang
on
it.
the health of the higher end consumer, but doesn't seem to be impressing Wall Street at all this morning. Shares
It's
down
trying to give me good
4%
hands. Oh, yeah,
right
the
now,
flush
no
is good thing I
negative
folded.
year to date.
Makes
Another
sense.
story I want to touch on, Jenny, are the
That would've been
huge
a
declines
tough
that we're
one.
seeing in solar stocks. I was talking about this with Oliver this morning, and it seems
Yeah,
like they're
solar's
really
getting
holding
wrecked
on
today.
to those losses. Solar Edge down 30%. Sunrun, Sunnova, Enphase all down significantly as well. Bring us up to speed on that story.
I know, and even First Solar, which was at one point one of the strongest of the group, is now pretty much unchanged on the year with some of the selling we've seen. So story is obviously focused around Solar Edge, pacing for its biggest decline on record since going public back in 2015. Following the fact they did pre-announce their earnings for the third quarter, the headline news was the fact they could expect a 20% revenue miss and a 30% reduction in their gross profit. However, they did credit this to some of the pushouts they've seen by the European Union distributors. So they did have some reasoning behind it, but again, that didn't seem to matter at all to the street. So many analysts now downgrading or reducing their price targets today. I will not go through every single one, but Goldman Sachs downgrading shares to neutral from buy, reducing its price target to 131 from 254. We did see Roth MKM also downgrade shares, price target of $100 down from 280. B of A with a neutral price target, or no, excuse me, downgrading to underperform from neutral with a $65 price target, saying this is not just another destock story. The messaging is far more starkly
25 minutes to
negative
EU
than
close.
just several data points would have suggested. So that was interesting commentary. Deutsche Bank actually reduced its targets for the entire
bears building
energy
liquidity or
space
for
now
actually reversing.
2024 and 2025, and also downgraded shares as well as Sunrun. They downgraded shares and cut their price target. So what was astounding to me is not only the fact that we're seeing downgrades, but the extent which analysts are cutting their price targets. I mean, some of these are by half or more than half.
Yeah, I was talking about that with Oliver this morning. For Solar Edge, it's only trading at $80 a share right now, so a lot of the price targets still imply quite a bit of upside. But last month it had a $300 median price target. Now the median price target is $176. So really disappointing on that end. Jenny, have to leave it there. Thanks so much for breaking down those top stories for us. All right, let's get some insights on the news that's shaping the markets. And for that, we welcome in Eric Lund, principal economist at the Conference Board. Eric, thanks so much for joining us.
Thanks for having me, Caroline.
So, Eric, I was taking a look at your notes, and you're calling for a short and shallow recession. This despite Jenny was just talking about, American Express was talking about this strong consumer spending. So what causes this economy to eventually crack?
Well, really, there's a number of things that we're watching right now. Firstly, just the interest rate environment. We've seen 525 basis points in hikes over the last 18 months or so. That's not going to go away anytime soon. Inflation is continuing to batter consumers, not quite as badly as it was last year. But we also have things like credit card debt, which you just talked about, rising. We had about $1 trillion in credit card debt outstanding in Q2. That seems to be going up more and more. Pandemic excess savings are starting to dwindle. And of course, this month we had the reintroduction of mandatory student loan repayments. So really, it's sort of death by 1,000 cuts. The consumer has really outperformed in 2023.
Yeah, no, I've liked Webull.
It's Q1 of next year.
They do it. They have a lot of features. Charting's nice, layout's good, and they're constantly improving it, which is the biggest thing. It's not just stagnant.
So I guess what makes you confident that it's not
constantly adding stuff
and more aggressive in terms
earlier
of,
on, it was kind of annoying. Remember when Webull came out?
One of the really sort of pillars of the economy.
It's like they
really
didn't have anything. They should have like level 1 options.
It's going to be the labor market. We're not expecting to see the labor market deteriorate significantly.
Couldn't do anything.
Companies had a very hard time.
And then for the longest time, you couldn't roll positions. I was like, come on, let me roll it.
To let anyone go.
But now I think you can do all that stuff.
We'll see a little bit of a softening, we think, in the labor market, but we're not going to see it really fall apart in the way that we did during the financial crisis or really during the pandemic recession either. So that's going to, we're thinking, going to put a bookend to the recession probably at the end of the second quarter of next year and keep it from becoming too severe.
So the jobs market likely to remain resilient, but you mentioned those student loan payments resuming as of this month. At what point do you think we'll start to see the impact there? And what will the overall impact to the broader economy be, given those new bills added each month?
Sure, I think it's especially important.
Or your mortgage going up by 44%
in the U.S. People who recently graduated from college and still have student loans that they're paying down.
I think
it's going to start to really weigh on the economy probably.
Other than it sucks really bad.
So moving into the holiday period.
Nothing, I guess.
But I think again, combined with interest rate.
Yeah, I pay for level 2 also.
Pandemic savings.
Even though I don't really use it.
Start to see the pullback probably.
I feel like a better trader having it over here. Makes me smart.
We are seeing some progress on the inflation front, though we still are well off the Fed's 2% target. What does the path to getting there look like, and what's it going to take from the Fed? Does it mean another hike to get closer to the 2% target?
Guess I could have slow played that a little bit.
The chief sort of variable in this equation is time. The monetary policy that's already been implemented needs time to weigh on the real economy.
Trading wise? Yeah, it sucks for trading.
From our perspective, we're looking at maybe one more 25 basis point hike later this year, and then we think the Fed's going to.
I mean, their Active Trader Pro might be fine. It's a super outdated platform, like most brokerages.
as the economy softens, as inflation continues.
But no,
to
the
come down,
outages they
they'll
have,
start to
totally
unwind some of
unacceptable.
that. But we're pretty deep into restrictive
Like, consistently
territory
having
right now.
outages.
So I don't think we're going to see the Fed really meaningfully pull back
Like
to
more
sort
than
of a neutral
Robinhood,
interest
more than
rate
Webull, more than
environment,
TD.
probably until 2025 or so.
There's oftentimes where
gonna
it's just
take
fidelity that's
time
out.
to get inflation back down.
Can't
to
even
that
log in,
2%
can't do
mark.
anything. That's
No
totally
Fed
unacceptable to me.
cuts, even though you're calling for a recession. And how does Jerome Powell's commentary
And
yesterday
ace,
play
well
into
done.
your view? Did you learn anything new? Did that change
Little
anything?
inverse head and shoulders here.
I mean, I think we were already expecting to see maybe one more hike this year. It may not happen in November, but we think potentially in December. In terms of cuts, I don't think that the Fed is going to flinch. Powell has been pretty consistent in what he said about being willing to exert some pain on the U.S. economy. If we do see a bit of a pullback, I don't think that he's going to, and his colleagues are going to meaningfully change monetary policy to evade, a softish kind of recession in early 2024. They're very focused on tackling inflation. So until we start to see, numbers come down towards, 2.5% or so, I think FOMC is going to be really reluctant to change course.
All right, really good breakdown for us. Eric Lund of the Conference Board, thanks so much for being here.
Thank you.
Really appreciate your insights. Plenty more to come on Trading
20
360.
minutes to
Next
you
up,
close.
the big three stocks,
Oh,
three charts, three trades. Ben Lichtenstein will take you through the technicals,
Lichtenstein.
and Tom O'Brien will
That like flash crashing? It must be. Happened earlier today. Probably format this computer again. Monthly formatting. I mean, yeah, if you're just holding stuff in it, like, it's not a huge deal, I guess, but what's the point of having a brokerage that sucks? Like, I mean, I don't know. Even if you don't use it for trading or charting or anything like that, if you ever need to, it's like, well, I don't see the advantage of being in it. Just disadvantages, so. Faster transfers for faster transfers? Yeah, I don't know. Yeah, they do charge a ton for contracts, don't they? I'm getting raped on these charges. I haven't even actually looked at that. That's bad. Check. Like 65 cents. Sometimes it's 0 though. If it's cheap enough, maybe. It's between 0 and 65 cents a contract. I'm getting 65 for all of them. I don't know why. Just damn. Am I bluffing? He's bluffing. Oh, the kicker got it. Yeah, I don't know. 0 or 65 cent a contract. All online option trades. I'm getting such good cards. This is insane. Buy to close orders of 65 cents or less. Oh, if it's... Jeez. If it's 65 cents or less to close it, there's no commission. But I think to open it, you're still paying that 65 cents. guy's totally tilting. Great. Dude, I'm cleaning up this table. That's good. Keeps me occupied from trading. Yeah, TD's the same. Has either 0 or 65 cents fee per contract. I don't know why it's both. There's no spades. One spade. Oh, you had an ace. Yeah, I think it's the same on TD. Actually, maybe more expensive because it's confusing. Maybe to close it. I don't know why it says 0 and then also 65 cents. Maybe a double bottom here. See, Robinhood says they're 0, but I think you're more than paying more than 65 cents just in slippage, bad fills. Payment for order flow. It is still enticing though, and it's just something about it makes you feel like you're getting a better deal. Don't like it. Yeah, I'd rather be in Robinhood than Fidelity. Robinhood, I mean, beautiful UI. They've gotten a lot better. Look at these cards, it's crazy. Now you can chart and stuff on Robinhood at least. Before it was like nothing you could do. To EU close.
There, it's actually off even more, off of almost 2.5% today, now down about 3.5% this week. Tell us about your trade for Amazon.
Yeah, so they're all coming into the bottom of the consolidation. I mean, you know, you get Amazon down $3 right now. Same type of setup, okay? That you know, we're down 40.
Oh, DRS was faster on Fidelity. Yeah, I remember the huge exodus to DRS or to Fidelity.
Yeah, the last 3 times we held, you know, at these
GME
lower
days.
levels. The real question is today, you know, yesterday you come down.
Weeble is China, that's true. So was.
The real question
Well, I guess
today
Robinhood
is,
isn't.
are you going to get a reversal?
I think it probably is still kind of owned by China somehow.
07, and we're at 125.
That blind guy, you know, he's got
so
China in his pockets.
Setup,
He's in China's
you can
pockets.
buy it here and still give it you know, give it a 1.5 or something, and you know, we'll see whether we can get a turnaround.
But that account's collapsed. I don't open that one up.
You know, coming into the closeout here. You know.
I've been trading on Fidelity. It's insane.
You can get some
like just on their
That's the bullish side. The
website.
bearish side of this is that when you've been
It is
down
like 8 steps.
3, 5 days
Like trying
in
to
a row,
scalp trade.
4 days in a row. You know, most of the time
wild.
you're down on Friday too. So.
Right now I can't do market orders.
Yeah.
So.
Sentiment is negative. Ben, do you see any signs of a turnaround when you take a look at this chart?
I'm seeing some weakness.
Robinhood's fine. Yeah, I mean,
they're coming under pressure.
They
downtrend on a more intermediate granular.
I mean, whatever, they're fine.
Also on the bigger picture, it kind of looks like it might have just double.
They're zero commission advertising though. Like I said, you're actually paying more than the other brokerage. I remember I can't fully technically figure it out, but I did test it. I remember like again back in the GME days, and just on fills and stuff.
You can see the 2 phases of development
I concluded that I was paying more with Robinhood than the other brokerages, even with their fees.
We can
So,
establish that we're in a trend to the downside.
I mean, you're gonna pay for it. It's not like you can just do it free. It's like you're paying for it somewhere. But yeah, it is just in the entry and exiting trades. So if we're holding long term, like yeah, I mean, it's nice. It's a nice UI and it's very simple and I'm down for that. A lot of active trading, like it's probably I'd say it's probably the most expensive. Which is why I have it in my long term. People raking in the money, taking advantage of all those apes.
Bigger picture time frame here. Daily candles in this instance. I mentioned the potential form a bit of a double top here, right around this 150 levels. We've come off. Further weakness below 115 opens up a door for a retest to those lows that we saw back in last fall. If you remember, the beginning of this year, we saw a retest around 90, 95.
Yeah, because since I already have a Weeble, I still have a Robinhood, I think, but
so again, this is
I already have the Weeble. I might as well transfer to this.
Sort of the mirror image
from
of what
Fidelity.
we're talking about in terms
but I do, yeah.
what we're looking for as far
Weeble's
the bulls to
more powerful, I
in
think,
last example,
as far as
Microsoft, right? The
features than
kind of
Robinhood.
flexing the muscle, right?
The UI isn't
The
maybe quite as
area that was
nice, but
significant for them to hold that 150 area.
what you can do with it, it's
again,
worth
further
it.
weakness opens up a door for a retest that lower extreme. I'm going to show
Because you still have a nice graph, like portfolio, and
relative to the 50, the 200-day moving average, because we've broken down below the 50. They don't want
that's
to
really
see
all
this
it is.
thing
Like
opening up
very,
the door
very
below
basic,
the
simple.
200. That would be very much supportive of what we're seeing. But I also want
It's
to
not,
point
it's not
to
like
the other
anything
side, which is
special.
exhibiting some weakness as
It's like all these
well.
brokerages are
Relative strength
so
indicators.
old
There's
and
a few factors at play here.
ape abuser,
Kind of bearish
100%.
in shares of AMZN.
All right, Tom, final trade is Meta. Shares off about 1.4%, still higher for October, up about 3%. And of course, this is the biggest gainer of the 3 year to date, up 156%. Tell us about the trade for Meta.
You know, so this one here, you know, you're down 450. Now, on all 3 of these, we're coming into strength, meaning October 6th, Caroline and Ben.
New low there.
Wide price spread, accelerated volume on the way up. So when you come into strength, as long as you come into strength with volume contracting, it's a decent level of support. And that's exactly what each one of these have been doing. So in Meta's case, you know, we could buy it here, same deal, put a 1.5 underneath it. And you're looking that you might get a rejection of lower price. You know, we've hit 306.47. It's at 308.18.
Definitely
right
change
now.
Robinhood.
This is going to be, everything's contingent on the S&P out here today. That's the bottom line. You know, that's what it comes down to. We're at these lower levels. You know, the real question is that can they spike the S&P down and get some fear in the marketplace? Because the only way this market actually can go up or does go up is that you get fear in the marketplace first, and then the baby flips. So, you know, it's been a one-way trip on the way down right from the open. You know, if they get more fear, you know, the bottom line is then you might have a shot of a turnaround. But if the fear is not there, you know, I don't expect this thing to turn around.
Okay. Ben, longer-term price target for Meta on Wall Street, 375. So Wall Street analysts see still quite a bit of upside for this name, which, as I said, is up more than 150% year-to-date. When you look at this chart, what stands out to you?
Well, I'm going to show you. It's kind of a mix of both the names we just looked at, but a compelling chart for sure. Let's take a look. First and foremost, you can see a high conviction trade to the upside. You've got it on the left side of your screen. We're going back to earnings back in April. You can see back in July, another big move up in follow-through continuation of the pattern that we saw, but that's kind of where we topped out, right? We retested that upper level around 370 back in earlier this fall, or this month, I should say, end of September, beginning of October. But what I noticed here again was just, as I like to identify these areas of consolidation that form, this is kind of one larger area, right? This is very mature, elongated, and we've been in this range for a while, but you can see that we've been forming value at higher and higher levels. And if we wanted to kind of pull out that really fine-tooth comb, we could establish that this pattern's played out a couple times even within this larger range that we have. Again, we've got an easily identifiable upper extreme, 330. We've got a lower extreme, 275. And look where we are, kind of hanging out just above that middle of the range here, right around that 300 level. But let's take a step back here. I want to show you what I noticed here. And I mentioned it's kind of a combination of the two names we looked at, right? As far as, well, trend environment to the upside, but a bit of a double top that's formed up here in this instance, again, around this 330 level, because that recent high we just looked at coincides with the highs from July. But adding some time on this chart, you can see still this uptrend balancing around 330 right now. So pulling back off the highs here, but maybe nothing to be too concerned about. That is, as long as we hold up above 266, right? That prior area balance, that reference relative to the current range that we're in right now. And then again, as I mentioned, much like what we were talking about in terms of Microsoft, we saw a very similar pattern play out because we had been in a really well-defined downtrend where these areas were forming at lower and lower levels. But look what happens. That stops, right? Not necessarily on a dime, but when it happens, you slowly start to take out some of the key areas that were established on the way up. A very short-lived, kind of immature, very brief period around 95, but look, up and through 132, and everything since then has been, well, if you're still short this thing, hoping for it to get back down there, you know, a hope, a whim, and a prayer. I mean, it's been a bullish stance since off that lower level, Caroline.
Yeah, and given that Wall Street price target, it seems like that would be a really good buying opportunity if that was the case. We'll leave it there. Ben Lichtenstein, Tom O'Brien, thanks so much for being here.
Have a great one. Have a safe one. Thank you.
Coming up next, we're going to spotlight the latest AI developments, what could be some new growth drivers in this booming industry, that and more after this. So we'll be right back.
Ryan Cronin has a crush on China. China. Weeble is nice for the price. AMC below VWAP now. I made new low. E below VWAP. Bottom is starting to taper. They have the queen. Sucks that 9 came out. No, he doesn't. That one little slow play is what got him in. If I'd kept pushing right there, he probably would have folded. But the slow play, then I got him to be the aggressor. Quite there. Excuse me, maybe it's close enough.
More of a lag. So I think looking at the sector as a whole, we're going to start to see AI come through, but it may be a little early for some of the hardware plays.
Okay, so I mentioned you brought some charts and data with us. I know that you kind of have an industry breakdown based on compound annual growth rates in terms of revenue. So fill us in on the sectors or the industries that are poised to benefit most from this AI wave.
Yeah, so our Future Intelligence team is looking out and tracking the market through 27. We see big sectors like media, entertainment, telco, healthcare, financial services all growing at 25% plus CAGR through 27. But that's spread. You know, the new data coming through, we'll see education, energy and utilities and real estate be laggards. So whilst AI is going to come through across the space, it's going to be very different from a vertical adoption perspective.
And what about in terms of retail?
So retail's up there. I think that's going to be one of the areas. We're starting to see vision and smart stores. Amazon Go is an example with cashierless stores, if you've tried one of those.
I go all the time now. There's one here right near the exchange, and I didn't realize how easy it would be.
It's fantastic. Just go in, scan, computer vision, being able to augment the experience there. I think those are early days, but we're going to start to see those come through. I was out with Lenovo this week at their headquarters in Raleigh, and there's lots of things in the pipeline that they're demonstrating coming through for retail. Real explosion there, smart shelf edges, really the ability to be able to move stock through quicker, not having to print things out, being able to, as I say, bring computer vision into the store. Really top line, but also addressing shrinkage and some of those staffing costs.
So you mentioned you were with HPE, you mentioned you were with Lenovo.
Busy week this week.
Yes, so you've been hobnobbing here. So tell us really key takeaways.
Hobnobbing.
Is it all about AI right now?
Is that like sandbagging?
These are companies that also have a fair share of headwinds in front of them as well.
Yeah, so I was, as I say, at the HPE Securities Analyst briefing just here yesterday.
Mixed socially, especially with those of higher social status?
AI AI questions. Justin, who leads AI for them, was getting peppered with questions in
Oh,
the Q&A
hanging out with
afterwards.
the labs
But
or something?
I met with, as I say, Antonio this morning. Compute's
It's a
not
socializer
dead
talking
was the
informally.
takeaway sentence. Still represents a
Can also
$12
mean to hang
billion
out,
business for them. So
spend time
I
with
think
someone,
whilst the
especially a
hype's
social
there,
event.
still some strong fundamentals from HPE. They put guidance out that they're seeing growth in the 2 to 4% range
Heard of that
over
expression.
the next few years. So I think it was strong guidance. I think the market's reacted not to some of the nuance in that guidance. I think Antonio was frustrated,
Jenny.
certainly when I met him this
Oh,
morning.
no, no, it's a little different than
I
that.
know he's hitting some of the
A
networks
slightly
today to try
variant
and
of
provide
that.
some context. But really strong position from them.
Yeah, you're pointing because he's just over here on the other side of the floor.
Man, those puts I got this morning would have been nice. Dang it.
But should we think
well.
about AI on a company's balance sheet as a line item that only gets bigger with time? Because companies are still cutting costs. They're very focused on budgets at this point. So can we compare it to like a cybersecurity, which is one of those areas of tech that should only stand to grow versus actually get cut?
Yeah, exactly. I think enterprises, as they look to deploy AI, are going to be looking at it as a way to differentiate how they provide service to their end users. Also, how they look to address that.
Maybe I should have been trained at gambling, you're right.
Around some of the software deployments, process optimization, predictive analytics.
This is keeping me from trading.
Visual and
I'm well
audio
aware.
analytics as key software areas. All of those
That's
are going to
that's my secret.
based on the future of
My
intelligence
trick.
data at 23% CAGR through 2027. So I think if you capture it correctly, it's going to be interesting to see how that's
kitty.
deployed.
So when you look specifically at AI
I always get a
cloud
laugh out of you,
computing
kitty.
revenue, what's the forecast there?
So CAGR that we predict through 2027 based on future of intelligence data is at 25.3%. So I think HPE, Lenovo, some of the other players, we've got Amazon reporting next week. They would play into
waiting for
that
my
as
trade,
well
it's coming.
with some of their inferential and training.
Oh,
play.
you closed 10 minutes
I
ago.
think it's going to start to come through and start to reflect. I just think we should be
It's the
aware
reversal
that it's
time,
not gonna
too.
all come this quarter.
Right,
Eventually.
and I think that we need to see if this is a market that will be patient enough. So what's going to separate the winners from the losers?
I think from my conversations with the HPE team and the Lenovo teams this week, it's the focus on the complete stack. Yes, we've got the data showing 25.3 on the compute, but it's also the software play. You look at where NVIDIA's built a moat around CUDA. It's not just having GPUs and fast processors. You've got to be able to go broader than that and move up the stack.
All right, we have to leave it there, but really appreciate all of your insights, your charts, and your data. Thanks so much.
Thank you.
All right, that's Stephen Dickens of the Futurum Group. Coming up next,
I was hoping for more of a bounce this morning to get my Feb puts on SPY, but didn't want to do that. We're fully down the bottom of the channel already. Just took 3 days. Indeed. I thought it was the Yaz all along, but it was just you, kitty. Oh, my browser's starting to go slow. Dude, what is this? Oh, maybe it wants me to update. Windows definitely wants me to update. I think it does this on purpose. It starts just like throttling everything to force you to update. That's slow. I want to call this. As an ace. I didn't get a spade. Didn't get the spade. Nice, Bubba. View up projection, theta burn, and then a dump into closes. What you're thinking, huh?
And EBITDA growth and sales growth is expected to be in the low single digits, which is modest, but that's to be expected considering this is a company that has longstanding partnerships and relationships with existing companies. They also have new technologies in partnerships or in conjunction with ServiceNow, and I think this is actually pretty meaningful as they start to integrate and deploy artificial intelligence within their IT infrastructure. So I think at the end of the day, this is a value-based company. It's not expected to grow very much, and they also pay a dividend. The dividend they pay out is about $1.77, and that's again about 30% of the $4.64 that the company is expected to earn in the next 4 quarters.
All right, but if it's a value company that's not expected to grow very much, it's already up 15%. Right. Year to date. Citi's turning more bullish, but the majority of analysts are on the sidelines for this name. What would your example trade for Cognizant be?
Yeah, so one, we have to be kind of nimble in this market. I think we may end up, testing the 200-day moving average on the S&P and perhaps overthrowing it. The other thing is, the company's not really a growth company, so I don't expect a large move in anything related to earnings for this name. So we can still participate, but it'll give us some flexibility. So what we can do is, if you look at the stock itself, coincidentally, around its 200-period moving average, which is below the current price at around 64.5, we could actually go out and sell essentially a short put spread below that level. In other words, selling the December 62.50 put and then simultaneously buying the 57.50 put below that. So this is a $5 wide spread, but you could place this earlier today for about $1.20 a share or $120 a contract in credit. So the whole objective is essentially for the stock to either obviously go higher, stay where it's at, or effectively it could drift lower to 62.50, and that's where we would still achieve full profit of $1.20 per share in terms of credit. But you have to be mindful of the risks and keep in mind that break even on this position is around 61.30, which again is still below that strike price. But that strike price we're selecting, that we're selling, the 62.50, also has a very low probability event for the buyer of that put. In other words, it has a high probability event that will expire out of the money.
All right. Thanks for the trade, George. We'll leave it there. George Sillis, always a pleasure. Thanks so much. Coming up next, it's time for our 360 round. Our panel will break down the latest housing data and what it means for the overall housing market. We're back right after this.
Grabbing a few calls there. Little starter. Oh, I thought he had pocket aces. Whew. That was a big, big pot. I love the pre-flop rebetting battle. Especially if I win. They win the money. They win the money. The money is mine. Alright, I got into some calls. But yeah. Get into some more. I want to see some breakage. A little pepperoni. Yeah, I was supposed to get on this other account too. Okay.
To more hikes, even though we are not of the thought that there will be more hikes, but you know it's a moving target very much so at this point. So I think as of spring and of next year we'll see a gradual decline, but we are not likely to see mortgage rates come down to 5% or lower anytime soon.
All right, so could be a positive sign that mortgage rates come down, but then we need inventories to come up. We have to leave it there. Selma Hepp of CoreLogic and Alex Barron of Housing Research Center, thank you both so much for your insights. That's going to do it for Trading 360. I'm Caroline Woods. I'll see you back here at 2 p.m. Eastern.
And to add more on this break, I wasn't paying attention. That break right there, right where it built a little liquidity. Dang it. Much stuff going on. For a pullback.
co-host Kevin Hinks. Kevin, we got to push into risk-off mode at this point. If you look at some flows into treasuries where you've got yields pulling back, that 10-year nearly hit 5% yesterday and earlier in today's session. But this seems to be risk-off. Geopolitical concerns going into the weekend. It seems like does nobody want to be long going into the weekend? Is that it?
Second Friday in a row, Tom. A jittery market bracing for events that could happen over the weekend. And you see it, we were seeing it earlier in gold. We were seeing it earlier in VIX. We were even seeing a little bit in crude oil and the US dollar, but now bonds have joined the party, and now they're fleeing. You see yields dropping pretty consistently here, pretty significantly on the 10-year yield. So you're right, Tom. Don't overthink a day like this. Moving into the weekend, much like last Friday, this is a complete risk-off day in the market. Crude oil, dollar is firm. That one hasn't been acting too much. VIX, you can say the VIX is soft to down, but remember, there's a Friday, Monday thing there, and so the VIX is still holding in there pretty high above 21. But Tom, for me, I look at this market, it's jittery going into the weekend. It is risk off as we go into the Fed quiet period. We have a boatload of earnings next week. Here's the numbers: 824 names, 164 in the S&P, 24 NASDAQ, 12 Dow Jones. We got 3 big economic data points for next week. So, Tom, there's a lot going on, but geopolitical has got this market with risk off. Tom.
Yeah, definitely. There was concerns if this thing escalates, and we saw some escalation yesterday. And we'll talk a little bit more about Fed Chair Powell and some of the comments he made yesterday. But let's bring up the big news story, or I guess it would be a sector story. A lot of the solar stocks under pressure today because of Solar Edge cutting guidance yesterday after the close. Let's bring in Jenny Horn, markets correspondent here on the network, to help us break this down. Yeah, Solar Edge down nearly 30% and putting a drag in this whole sector, Jenny.
Yeah, and I will say that this stock has also underperformed even with today's 30% move to the downside, which actually puts it on pace for its worst day since going public back in 2015. So even though we are seeing sector weakness, the story is very Solar Edge specific. They slashed their third quarter outlook pretty significantly, now expecting their revenue in a range of 720 and 730
Didn't quite get the
million
view up
versus its prior outlook, which was between 880 and 920 million. So rather significant. Their CEO did say late Thursday that during the second part of this third quarter, they experienced some substantial unexpected cancellations and push-outs of existing backlogs from their European distributors. So they did have at least some reasoning. It wasn't completely unprecedented, but they do still now expect a significantly lower fourth quarter revenue as inventory destocking does continue. So they don't only expect the third quarter to be disappointing, they expect that to also linger into their fourth quarter. We can expect now these third quarter results November 1st, but what we know is the street really didn't like this news. Like, we're seeing so many different analysts across the board reduce their price targets, reduce their ratings. And what's so significant to me is the size in which we're seeing some of these price cuts. I mean, Goldman Sachs downgrading to neutral from buy. Price target of $131 a share. That's down from $254. Roth MKM also did cut its rating with a price target that was down to $100 a share, down from $280. B of A, another one with a $65 price target, also downgrading shares, saying this is not just another destock story, and that the messaging is starkly more negative than several data points would have even suggested. Deutsche Bank also downgrading shares with a reduced price target to 150 from 300. Also cutting its price target now on Sunrun today. So what's amazing about all of these price targets, though, is right now with Solar Edge, I know it's making a monster move lower. It's at $80. You have to think, like, with a $254 price target from Goldman, for example. I mean, where was the reasoning behind that? That is implying such significant upside. I actually think a lot of these price target adjustments seem more fitting even with today's monster move to the downside. But if you look at collectively the average price target among the analysts covering this name, it was $300 a month ago. Now it's around $150. So we've seen a reduction by half. But again, $150 implies some significant upside to where we're trading today.
Yeah, Jenny, talk about ruining someone's weekend. This is a big move in this name. And Jenny, we could probably do a whole show just on this topic, right? This industry, this sector of the U.S. economy got a ton of cash thrown at it from governments. They overbuilt supply, and demand is simply not there. Their sellers are saying, don't send us any more supply. We don't have the demand. And that supply-demand out of balance has got to be rectified, Jenny. But boy, this is a horrible way to start your weekend, Jen.
It really is. And I would say also the divergence in some of the performance of these stocks this year has been astounding. I mean, First Solar has been one of the brightest spots, but it's now, I mean, pretty much unchanged on the year. So with today's move lower and this week's move lower, now giving up a lot of that strength. But we've seen such stark differences in performance. And a name like SolarEdge does have more exposure to some of these different solar panel and different parts that have faced supply chain delays all year long. So I do think it's interesting to differentiate these stocks because it's not like the solar space is all just in one coexisting area. They all do trade with different reasoning. But the one maybe bright spot, and to maybe end on the most optimistic note I can give, is that we are seeing obviously so much selling today, so much weakness collectively in the solar space. Perhaps then this does lower the bar for their earnings. So when we get those results November 1st, any sort of upside now for the remainder of their fiscal year could be seen as a win. Because again, with this scale of the
they pulled that
move
flushes.
today,
Oh my gosh.
any optimism I think would be welcomed by analysts and investors.
Yeah, those initial costs on getting a solar panels put on your roof, pretty hefty at this point. So maybe that's part of the reason we're seeing weakening demand. That upfront cost, even though over, I think, 15, 20 years, it pays for itself and more. I think that's going to be a headwind for a while. We'll have to wait and see on that. All right, thanks to Jenny Horn, markets correspondent here on the network, breaking down the SolarEdge and the solar story, as most of that sector pretty weak today. But now let's bring in Joe Mazzola, Director of Trader Education at Charles Schwab. Joe, I wanted to get your take here, not only on the move in volatility. We see the VIX back to levels we haven't seen since the end of March. And, this is all based on, if you looked at yesterday's trade, between the choppiness, the roller coaster ride we had just in one session, it seems to be that volatility is here and it might be here to stay.
Well, it does. And, you talked about volatility in one session. You had volatility in one speech, basically, right? As Powell maybe came up a little bit dovish to start, markets reacted positively to that. But then, comments at the end talking about higher for longer, you saw the stocks retreat off that as well. And I think what's interesting, and Kevin kind of touched on this a little bit earlier, is heading into the weekend, what could happen in politics. One thing I find really interesting is why aren't we seeing bonds rally more, right? You would think that you'd see the 10-year yield go back a little bit. There'd be a little bit more flight to quality. I think the big issue facing the bond market right now and causing some of that volatility that we're seeing in the MOVE index, which is, in my mind, making its way over into equities, we just don't have buyers. The Fed has stepped back. They're selling. Japan is trying to defend their own currency, so they're not buyers of our debt. And China's stepped back as well too. Those are the three biggest buyers of our debt, three biggest holders of our debt, and they are not stepping in to support the bond market. So, what I guess the question investors need to ask themselves is, what level of yield does the 10-year have to get to before people are willing to kind of step in? We talk a lot about equity risk premium. Well, there's a bond risk premium too. Mm-hmm. And that bond risk premium right now is showing that investors aren't comfortable buying bonds unless they're getting paid more in terms of that fixed income yield. And maybe 4.95% isn't it. Maybe we need to go a little bit higher before you start seeing the public kind of step in and fill that void.
Yeah, and I've heard some commentary. Not only Jamie Dimon said that hey, maybe 10-year needs to go to 6% or even higher. I heard some commentary from Lee Cooperman and some of these other, Wall Street legends saying, hey, they're not, touching bonds at this point. They expect yields to continue to move higher. But Kevin, that volatility, we were on air and we saw it live yesterday when Powell was speaking. To Joe's point, I mean, we were positive, then we were negative, positive again. I mean, it didn't seem to know, the market didn't know what to do at that point. But the takeaway from Powell's comments, even though Bostic pushed back against it, he's a little bit more dovish, as we all know. But, Fed Chair Powell basically said, hey, we haven't seen any pain yet, in the markets based on what we're seeing as far as the yields go and some of the actions that they've taken so far.
You landed 2 pair?
Well, I'm sure there's some executives
Bluff
at
it
some
till you make
regional
it.
banks that would disagree with Jerome Powell saying there's no pain.
Yeah.
But you're right, though. The economic data, aside from some of the inflation data, is still coming in relatively strong. We're getting a lot of strong economic data. But like I talked to Oliver Rennick yesterday on the air, it doesn't seem to be showing up in some of the inflation data. The inflation data is fairly muted, other than PPI, which the market likes to kind of shrug off, right? If that starts to show up in the other numbers, then we've got a whole new set of problems, guys. But remember, we're going to get a PCE data next week. That'll be another good look ahead of the Fed meeting. I think, listen, as long as we can get strong economic data and less inflation, that's the soft landing that we're looking at. But if one of those were to change, like the economic data drops or the inflation goes up, one or the other, and the soft landing narrative kind of fails. So, yeah, so far so good. Jerome Powell was able to kind of toe the line yesterday, and you saw the market reactions as he was doing that. But once Jerome Powell wound up some of his comments about noon yesterday, Tom, if you look at the 5-minute candles yesterday and today, straight down from there. We rallied up to about noon Chicago time and then have gone straight down since there, Tom.
Yep. And if you look at the inflationary pressures, you got higher yields, you got crude oil rising again at this point. You've got wages rising, a robust jobs market. Joe, it doesn't seem like that trend that we've seen as far as inflation kind of falling and getting back to more comfortable levels. Maybe it stagnates here, and that's a problem because the Fed still has that 2% mandate, right?
Yeah, I mean, we talked about it for a while. I don't want to say the easy work, but the easier work has been done, and the second leg getting to 2%, that's going to require a lot more work, and that's going to require an economy starting to pull back. And even in Bostic's comments, he did mention that he has heard stories from business leaders that they're starting to see some of that economic movement kind of slow down a bit, and I think that's the case. I think that's probably something we will start to see at the beginning of 2024. But the thing is, we keep pushing it back, right? I mean, these were conversations we were having last year as expectations for 2023. And I think the bond market, that was the expectation really basically all year up until around June, when things did start to change a little bit and you started to see the back end of the curve start to get bid up. And like I talked about earlier, I think when we look at the fact that the market is re-steepening again, and we're not seeing the inversion to the extent that we did, think about what's getting us there. It's not your traditional re-steepening where you have the Fed cutting the front end. The Fed's doing nothing to the front end. If anything, the only thing the Fed's done over the last 4 or 5 months is a 25 basis point hike in May. So if anything, they've kind of sat still. It's been the back end of the curve that's been moving, and as you guys mentioned, doing the work for the Fed. But what has that meant? What that's meant is that that supply is overtaking demand. There's just not demand in the back end of the curve right now, and it's pushing the rates back up.
Yeah, that 2-year, 10-year yield is down to minus 17 basis points. So this is we haven't seen these levels since September 2022. So that curve in re-inversion taking place right now. Kevin, and maybe even Joe, I mean, can earnings next week rescue us? I mean, we've got big names: Google, Alphabet, Microsoft, Meta Platforms, Amazon. I mean, legitimately, expectations are pretty high for these companies. You've seen the moves in the shares. Can that rescue the equity market, or at least stop the bleeding?
Yeah, and guess what? Expectations are high, and so are valuations on some of these names. So you've got an S&P 500, and remember, we're through the banks now. We're getting through, almost done with airlines. We get Southwest, I think, next week, and then we're pretty much done with the airlines. Then we get into large cap tech, and you see the reactions in Netflix and Tesla to earnings. 2 different directions, both outsized moves, Tom. So expectations are going to be high, yes, but valuations are high. Remember, we used to scream on this show for a while how cheap Meta Platforms was with its PE. Well, it's not cheap anymore. You know, a lot of these companies have had great long runs, and the valuations are fully priced. So, yeah, next week could be a fun week, but there also could be big outsized moves if they don't hit those numbers, Tom.
Yeah, we've got.
I'll go one step further on that if you don't mind, real quick.
Yeah, go ahead.
Communication services is expected to be the best performing sector in terms of earnings beats. You got Google and Meta next week. If they don't do well, that could portend some poor movement in the market. If they do well, given their market caps and given the expectations that are put ahead of them, you might see a nice little bounce off that. So those two are massively important next week.
Yeah, Google up 53% so far this year. Meta Platforms up over 150%. So to Kevin's point here, valuations they've already priced in a lot of the positive
inverse head and shoulders maybe down here
that are out there on the street. I think that's going to be a big question to answer next week. But great point there, Joe, to bring those up because digital ad spend still up.
Yeah, this was a pretty weak.
Pretty heavily. Okay, guys, let's take a quick break. We come back, we're going to talk CrowdStrike in the cybersecurity space. Stock got upgraded yesterday.
Didn't even make it to
it's had
VWAP.
a pretty good year so far, just off of 52-week highs that we hit yesterday. So we'll talk cybersecurity.
It is still early though. We're in the chop hours. All right. SPY just building some liquidity here. This is some ugly price action. Got tied up there. Didn't take calls here, but I'm pretty glad I didn't. Not sure how that would have ended. I am market. We'll see if it continues this uptrend it's built. Breaks here, I'll probably grab some puts. Get a little inverse head and shoulders on the bottom of this thing. I'll get some calls. Got what, 3 hours to go still, so still plenty of time, but it's not a whole lot of good setups for today. This morning was an okay setup. Just have my stops too tight. Gotta get my confidence back. I was riding without stops for so much of the day before, Wednesday, Whipsaw Wednesday, that I wanted to be more strict about my stops. So yesterday and today I was more strict on them. To where yesterday I shouldn't have even had it because it stopped me out, of course, with all the Powell volatility. Readjust, recalibrate, position, recenter.
Join me, Oliver Rennick.
By the time I could get into that, it was already a VWAP. Oh my goodness. Joke. It's like that's a choppy day. Marcus doing that. Catch. Wow. It was like right on the verge of my price, so I had to change it from market because the market order was too much for the dailies. I had to go to limit, and then it's just that time I fumbled all through that. It was gone. Too bad I'm not just a computer trading this. Hey, what a great idea. AMC up above VWAP. Dang. Okay. Oh well. Missed my entry. Thought I was prepared, but I wasn't. I was trying to do it on this small account. I'm gonna catch dailies. Today and yesterday, man. It's like just these volatile, choppy moves, like chop liquidity all day and then volatility for like 3 minutes. It's a trade in the channel anyways. But the thing is, it could very well break out at this point. Those are the best. Catching at the bottom of the channel, hold channel up, and then it does its breakout. Or top, channel down, does its breakout.
Our break-even points. That's the idea here going into this, Jenny. We're going to need this to break outside of that range.
So like Rick said, this has been pretty sideways. We need the exact opposite of this to happen. We need anything but sideways into earnings. And I agree. I mean, this name has been another one that's been able to position their earnings calls relatively well. And I will say, so is Alphabet, because Alphabet hasn't always had the most exciting earnings calls, but they have done a great job reframing that in the last couple of years. And again, I think I'm just, some bias is included in this because I'm excited to hear about YouTube. But Rick, as far as the technicals go, what are you watching here in Alphabet?
Another tech giant, another extremely strong
logged
chart,
in, I
even
couldn't have done
stronger
that
than our
trade.
last one. We're up about 64% off those yearly lows. Not seeing the same slowdown, really. Our last chart, we had a broken uptrend that was just kind of drifting sideways here. But we can see, although we did recently break below this upward sloping trend line, we actually kind of still were trending upward here. We were still making a series of higher lows and higher highs. So even though the trend line was breached, we managed to move into new yearly highs shortly after here. So just kind of an interesting situation. Important to sometimes keep these old lines on your chart. They can still come back into play even when you don't really expect it. But we can see once again we are at a crucial point. We are on the precipice of breaking below our yellow 21-day EMA, coming in right around 136.52. We're a little bit above it at this point here. But once again, that would be a key area to watch as we head into the close here. A close below that level would be worth noting. That would be a bearish sign. A close below that level also probably would start pushing the slope of our moving average itself from upward to downward, or maybe sideways, but most likely downward here if we had a bad close. So that would be an early warning sign of potential trend change here. And this is the canary in the coal mine, so to speak, the 21-day. That's our shortest term moving average. It's the one that reacts the fastest to changes in price. It's also the most susceptible to fake outs. So you kind of have to make a decision as a trader. Do I go with this, or do I wait for further confirmation, perhaps from one of our longer term moving averages or one of our other technical sources of information?
So I love this, and I love the idea of a potential trend reversal or change, at least, because right now it feels like the markets are just waiting for the next catalyst. A lot of these earnings could be that catalyst, I think. It may be to the upside even, because I am a little bit tired of this selling. But walk us through now momentum of the trend here, of course, into this earnings event.
Once again, kind of a similar picture here. Long-term deterioration of upside momentum, trend line going across the highs. But the big difference here, the really important difference, is that as we've seen this decline in momentum, prices continued to rise here. So you would have been in a tough situation if you were trying to make a play based off of this kind of bearish divergence in, between price and momentum. Price kept making new highs. RSI was not making new highs at the same time here. We're also pretty close to the 50 midline here. That would be another bearish signal. You can see that we are kind of drifting down toward that point here. The crossover would be the thing to note if RSI were to close below 50. So now we can see as well, you know, the trend line, I think, is more important than the divergence in this case. We can go on for a long time, and you would be getting crushed if you were trying to go short this from the beginning of this move upward. You know, it's why it's important to have a stop loss, especially when you're doing this type of trading here. Get a point where if things are really going against you, that you have a plan, an exit strategy, so to speak.
I completely agree, and I think it's sort of been impressive the way that it's up 4.5% this month, even in spite of some of the recent selling. And it just goes to show the resiliency we've seen from Alphabet all year long. But now, some key price levels you're keeping on your radar, obviously into earnings next week.
Volume profile once again sheds light on important trading areas here. You can see right around 136, we have a pretty obvious spike. Right around 133, 131, another obvious spike here. So these are areas where you might expect to see some consolidation. You might expect to see price kind of, you know, moving sideways or you know, finding support or resistance in these areas here, these areas of high conviction. So we can see once again, price in the thick of one of these nodes that we're highlighting here with our shaded area here. If we were to keep moving to the upside, 136 I think would be the first hurdle, based on the point that we reached some highs and some closing highs several times around that area. The old highs near 141.22. That's the real mark to beat, though. To the downside, around 133 or so, because we have our 63-day EMA. We also had points where we closed around that area numerous times as well. Sometimes these things aren't clean, cut and dry on the money. It's a general area. The 133 area around that point stood out to me.
And I would say rarely are they actually, unfortunately, clean, cut, or dry. But when looking at this name, it's been consistently moving to the upside. So a really great breakdown on both of these tech names into earnings next week. Victor Cat, our chart masters. Now, when trading this name, Alex, walk us through what you're thinking. We also have pretty much the same duration ahead of this earnings event. Alphabet has fared a little bit better than Microsoft this year, but has also been met with some of the same pressures of, say, disappointment in AI. But all things considered, I mean, it's still seeing a nice year.
Yeah, I would say inertia is still in the favor of a name like Alphabet. When you look at just how strong this trend has been, it's weathered the recent market volatility much better than other names. It's only like $4 or $5 off those recent highs, just over 141. So looking at a more bullish strategy here, it's risk defined. It expires next week. So this truly is a little bit more binary, directional type of a trade into this earnings announcement. Looking at buying a one in, one out call vertical. So buying one call that is in the money, selling one that is out of the money, creating a $5 wide spread from 134 to 139 for a 250 debit. Now, granted, the stock was a little bit lower priced in terms of today's action earlier, so I don't know if this price would still be there, but at the time it was around 250. At 250, it created a 1-to-1 risk-reward ratio, 250 and 250, with a break-even of 136.50. What is our other guideline for these, Jenny? It's to have that break-even close to the current share price. Well, as we speak, 136.65 is a trade price. It's pretty darn close to 136.50.
Yeah, and even, I mean, this week it's been impressive the way this name has been able to hold on. So obviously, let's look forward to next week as far as earnings, but that'll do it for this segment. Now, coming up next, we will recap another name that already had its earnings this week and is seeing some favorable price activity, at least week to date, slightly lower today, but that's Taiwan Semiconductor, as the street still really likes this name and has strong beliefs now into the back half of this year. We'll discuss more coming up next.
GME's waking up a little bit there. Held up pretty well, 2.85%. Not bad. Just a little volume. It is OPEX today. Wonder if we'll still get one more trade set up.
for the market to withstand.
Yeah, there are a ton more earnings even outside of these big tech names. We were talking about Coca-Cola, GE, and Boeing on Morning Trade Live earlier, and I was joking, these are the Dow stocks. These don't matter as much, but of course they do. There's so many names reporting next week. But now to relook at this week and the week that was as far as several big earnings moves, Taiwan Semiconductor actually has been able to hold on to its week-to-date gain. It's up 1.5%. Not necessarily a huge move to the upside, but still an earnings event that seemed all in all positive for not only just the company itself, but for maybe the rest of the semiconductor industry, which did face its own specific headwinds this week. But today, Goldman Sachs adding Taiwan Semiconductor to its conviction buy list, saying following their quarterly update, also they did see that the end of inventory correction could be showing some signs of demand stabilization in PC and smartphone markets. I have been hearing this narrative, though, Alex, what feels like for the better part of the last year. I will believe it when I see it, that we finally hit this bottom in terms of PC and smartphones, because it doesn't seem like that has come to fruition yet. Now, their earnings, I will say, did lift some of the overall gloom surrounding the chip sector. We did see that they gave a pretty upbeat outlook into 2024. Could be good for Intel as well as some of the other semiconductor space. They did say that demand for their latest chip technology was helping offset a glut of semiconductors caused by the falling demand of these consumer electronics. Even though their revenue did fall about 11% from a year ago, it was up 14% from the preceding quarter. So that is a sign of improvement. They also said revenue from their customers in North America now make up around 69% of their total revenue. That was up from 66% in the prior quarter. But all in all, did seem like this was at least somewhat of an optimistic tone heading into right now Intel's earnings, which will also release next Thursday after the closing bell. Another name to keep on our radar here.
Yeah, and as you mentioned, about 70% coming from U.S. customers, 10% China, 10% Taiwan, and the rest is made up by the rest of the world. This is the largest dedicated contract semiconductor manufacturer in the world with roughly 30% market share. 85% of its sales is wafer manufacturing. 40% comes from smartphone, 40% from high performance computing, 10% Internet of Things, and then some of the other stuff all make up 5%. But we forget about just how massive this is. If you're 30% of the world's market share in anything, you're a major, major player. This is a semiconductor player with 30% market share. It is so overshadowed, and simply just because it doesn't grow at the same rate. When it comes to the weight in this space, few names, if any, rival the importance of this particular company.
I know, but it always, every time we talk about this name, I'm flabbergasted by that, because they make the processors for iPhones. They also make some of these mobile chipsets for Qualcomm. They also have some exposure to NVIDIA's various chips. I mean, they have a $40 billion investment in this manufacturing site in Arizona, which is expected to supply chips to Apple in 2025. So they have so many of the most powerful customers in the world. It's quite amazing to me that it is like an under-discussed name.
Of those 10 largest customers, 80% of the net revenue for Taiwan Semiconductor. So much like some of these other names we talk about, the exposure to the Apples of the world, so important for a name like Taiwan Semiconductor to maintain those relationships going forward.
And I know they've had some hiccups with their factory that has been seen as the best way to pave the way for that relationship with Apple. I know it's already existing, but that's seen as an extension of their relationship. But they said that they are now on target for that to continue production in the new year. They gave really positive outlook on that specific factory. So that was, I think,
the
also
one in Arizona.
Right, the one in Arizona. So that was also another huge bright spot. I'd say this name is up 20% this year, roughly. It has pulled back about 17% from its highs, but still has been a relatively strong name this year. Not as strong as you'd think with some of its big customers, but Alex, with that in mind, I mean, what are you thinking for an example trade? We do already have this earnings event behind us.
Yeah, you know, I was just thinking about it, and it's a one beta name, so it's not typically as volatile as some of these others that we talk about. If you look at implied volatility right now, it's sort of in the mid-30s. Seems a little bit different. You know, by comparison, a name like AMD is upwards of the mid-50s historically, so it doesn't move quite as much, and some of that has to do with its more mature role within the space. It's not seen as this hyper-growth company the same way NVIDIA, AMD, etc. are. That being said, from a trading standpoint, there's certainly optimism. It hasn't necessarily screamed to the upside the same way some of these other names are. Say you believe that there's still upside to be had in a name like NVIDIA, I looked at a strategy that would benefit from a continued move higher. Now, I went to a weekly option cycle, Jenny, because it allowed us to get single dollar-wide strike availability, but we still go out a fair amount in time. So we're going to December 1st for this expiration, and what we're looking at is a skewed call butterfly in which we're buying a $7 wide debit spread and then selling a $3 wide credit spread, all of this centering around the short strikes at 97. So in particular, December 1st, 90 call, buying one of those, selling two of the 97s, buying one of the 100s to define the risk. If we're able to do this for a 250 debit, that would mean 250 bucks in total risk on this. If this stock was below 90 on that December 1st expiration, 92.50 is the break even. And of course, its best case scenario is a rally right to 97. Now, granted, it can overshoot that, but there's no upside risk. You would just theoretically give back some of that max profit potential. This is because of how it's structured here. $7 minus 2.5 still leaves $4.50. That's your max profit. And then you just could give back 300 of that. So you see where it flatlines past that 100 mark, it would flatline at a $150 max profit in that outcome. So no upside risk. Best case scenario move to 97, but risk defined in the event that the upside just
spikes.
Right,
That's
and of
crazy.
course making a modest move lower today, down about 1.2%.
I got some calls in the channel break, but
that'll do it for
like,
FOMO. Now coming up next, we
just
will look at a name that
ridiculous.
is not making a modest move to the downside, and that is Solar Edge, as it's one of the worst
Man.
performers on the session. It is down almost 30%, pacing for its worst day since going public nearly 8 years ago. We'll discuss more why coming up next.
Bad day for trading. Another one. Bad. Crazy when this thing turns on, it just like turns on like crazy. The nature of it, I think a choppy day, a lot of liquidity, probably a lot of volume today too. Closing a little bit here.
Let's get nuts!
Indeed. Is it time to get nuts? Tony, thank you, sir. Your generosity, I appreciate that on this lovely Friday afternoon. I'm to work, never got around to DRS my shares, just logged into E-Trade and saw they're gone as the news come out that it's completely over. It might not be completely over. So nothing's really changed as far as the narrative of getting equity in a new company. Them taking the shares out of your account is not necessarily, that could be a step. I mean, before you get new shares doesn't mean your old shares would stay there the whole time. Those shares were worthless. So I don't think it's over yet. As crazy as that might sound, I think there's still a chance. it's sort of like a, could be like a recall, because there's like trading right now. It's not like they're just gone, because I think they're still in your brokerage. They're just not showing up in your portfolio. They still have you on record as owning those shares before it got canceled or deleted or whatever terminology. So yeah, I think there's still a chance. Maybe a little double top there, I'm not sure. I've scaled out of a lot of these. Just kind of sad, but we have a rip. It's way too choppy of a day. And each of these candles were just in seconds. If you get a retest on this channel. GME new high, they're up 3.3. If nothing else, it's good that something's at least happening with your shares. You don't have to be in limbo, because nearing the end, one way or the other. Oh my goodness, look at that beautiful double top. It's probably too late to DRS. Like, it probably doesn't even matter at this point. You could call and try, but I think you're more looking for shares of a new company. I think that's pretty much your only out at this point. But DRSing the old shares probably doesn't matter. I think at this point it's pretty clear that those shares are worthless, and yeah, you maybe even couldn't DRS them because it's maybe they have no value. But the value that you potentially have is the position you did have in it, which could be carried over to another company. those calls. Waited way too long. They put a stop. Manual stops are always too slow. Had a break, had a double top. See if you get the put opportunity now. Maybe not though. We're close to VWAP. It's getting towards the end of the day. Very well could just chop around here the rest of the day. Unfortunately. Fortunately for trades, I didn't get a trade today. Didn't get any good ones in. This one was gambling, so trying to force one. Yeah, Tony. Thank you, appreciate it. Yeah, we're just getting some VWAP chop. Dang. Might be breaking to the downside here. We just still have 2 hours, I guess. Plenty of time to go somewhere, but just Still on this channel, huh?
That just don't have the strength of their balance sheets, like the mega cap names, and these solar stocks obviously getting punished today. It just fuels the fire of the selling, adding to this weakness. But really great breakdown all in all on all these solar stocks, specifically Sunrun today. George Tillis, senior markets correspondent here for the network, and that also does it for Alex and myself for Next Gen Investing for this entire week. Have a wonderful weekend all. We have the watch list hosted by Caroline Woods coming up next.
Up, psych you up. Debro Delek. Or Chubo Deli? Same to you. No more working from home. That's true, she hasn't been, GameStop, 3.5%. Need to bounce off the lows. Gonna get a T+2 on OPEX, huh? That'll get you jacked up. Nothing like a little Tuesday GME rip. All these options expiring in the money. Coming, man. Oh, that's Monday. Yep. morning in Dzongkha language.
Roth MKM Partners and Deutsche Bank, and they were basically surprised. They expected a little bit of weakness, Caroline, but I think the key point that they said was the margin compression. So that's going to probably relate back to inventory issues as demand wanes a little bit for solar installations. But yeah, not a lot of pretty sights here for the solar industry to wrap up the week.
Yeah, certainly a bad day for solar stocks. Now to the upside, we do have GM actually moving higher, bucking the overall weakness. I'm actually taking a look at shares. They're up about 1.4% right now on news that GM submitted a new proposal to the UAW. What do we know about this new proposal?
Well, the proposal is pretty robust, historically for this company. Now, Ford came out at the end of last week and said, hey, we're done going higher. We can't go any higher. It's going to hurt the overall company. GM came out with their best proposal now, which includes a 23% general wage increase. UAW represented employees at GM will make $40.39 per hour on average. That's $84,000 per year based in base wages by the end of the agreement. All GM UAW represented team members will receive that immediate wage increase. That 23% increase over the $32.32 per hour that most factory workers make currently, that's compounded annually at about 25%. They also reinstated cost of living raises for many of the employees that were given up in 2007. That'll boost the pay increase to over 30% by the end of September of 2027. New car registrations in Europe, those increased by over 9%, reaching 861,000 units. So that was a bonus as far as demand side. But one thing to watch here, Caroline, going into the end of the day, at the close, 4 p.m. Eastern time, Sean Fain's going to go on Facebook Live to update members on the bargaining after a week of intensive negotiations with the Big Three. Now, a lot of people don't see any end in sight to the strike, Caroline, but at the same time, I think the automakers are getting close to being done giving in a little bit. And I think one of the caveats that they're not going to give up is that 4-day work week or that 32-hour work week that the UAW is pressing for. But we might start seeing some resolutions come to fruition here, maybe over the weekend as they increase talks. But we'll get some more clarity from the UAW president at the end of the day.
All right, we'll certainly look forward to that because Sean Fain always has interesting choice words to say. GM and Ford both higher right now. Stellantis, though, a loser on the day and a loser on the week. Tom White, thanks so much.
Thanks.
Now let's take a look at the bigger picture with Shams Afzal, Managing Director and Portfolio Manager, Carnegie Investment Counsel. Thanks so much for joining us today. So let's go back to the broader markets. We're seeing weakness today. We've really been seeing weakness on the week. The Nasdaq off more than 2% on the week, about 2.2%. S&P off about 2%. Russell down a little bit less than that. What's your take on the weakness that we've been seeing? What do you attribute it to?
You know, I have to say the statements from Powell yesterday, most observers were probably looking at much more of a balanced take, much to what, Fed member Bostic or Harker even delivered over the last few days. But I think what they found was, on one side, it was much clearer that the chances of a rate hike in November is probably not in the cards. But the wide door open left, for a December one or perhaps even one later was just not something that Wall Street was looking for. So on balance, I think it was disappointed in that the Powell did not match the sort of the cadence that was received from member Bostic and Waller and some of the other Fed members.
So we saw equity markets turn lower, and then we, of course, saw that spike in the 10-year Treasury yield surpassing 5% for the first time in, something like 16 years. What do you make of that spike, and where do you think the peak in yields is?
Well, I think, 5% is not an extreme level. The fact that it's gone to these levels so abruptly is probably what's causing some people to do double takes here. But if you go back to 2005, 2006, we've had 5% yields back then, and we still managed to have decent GDP growth. So I don't think it's a deal breaker by any means. But overall, we think that 2.5% real yields is just not warranted going forward, right? It just all depends on when the rate cuts begin next year. But I just don't think 2.5% is what is actually needed. What the neutral rate ends up being is anybody's guess at this point. But I just don't think it's at these levels, right? So we can touch 5%, maybe overshoot it for a little bit, but at some point it has to give. I'm not saying that we remain, inverted for the duration of the next couple of years, but this uninversion that we have seen, I think, is just gotten down a little bit too fast and too abruptly in my eyes.
And it's not necessarily pointing to a no recession scenario, the uninversion.
Right. I mean, historically speaking, the uninversion actually speeds up the recession calls, right? And so that's another thing to watch out for. But a lot is depending on whether we stay at the 5% level, because the parabolic move, if you listen to the technicals, experts in this space, they say when parabolic moves happen, they just don't tend to meander afterwards. There's a pretty decent correction that comes after, right? So I think November and December will set the stage for, what's to come and really what the neutral rate is going to be for the economy going forward.
So if rates could stay high, yields could stay high, maybe not spike all that much more, but, obviously it's a headwind for this market. And if the yield curve is pointing to maybe a sped up call for a recession, how are you approaching this market right now?
Well, I think while we are sort of in the camp of that a soft landing is very much possible, right? But in terms of what we're seeking out at this point, tends to be sort of the companies that are not so directly tied to consumer spend. Even in the scenario or the framework of a soft landing, I think we can expect the 2% GDP rates that we have seen from this year is likely not going to sustain into next year. So the names that come to mind, obviously, Abbott Labs is one of the names that have reported this just this week alone. And I think there's some strong fundamentals happening where the market has sort of set aside all the device manufacturers in a way as if they're all going to succumb to the pressure of the mighty Ozempic, right? And if you listen to both Intuitive Surgical CEO and Abbott Labs from a couple of days ago, they say that they're seeing an uptake in the number of people, the patients, that are on GLP-1 drugs that are also happening to use Abbott Labs CGM device, the Freestyle Libre. So it's not a lose-lose situation. I think we may find that a higher number of populations within the type 2 range is choosing to add a monitoring device to their overall regimen with Ozempic, right? So that's one of the areas where you're looking at the demographics in a way without looking at direct consumer spend.
You also like U.S. Bank, though, and that's under pressure today. Regionals in general are under pressure today. Why that one?
Well, I put that in the speculative column, right?
Yeah, puts on
I
that
would
break.
say that if you want to get your 7 hours of sleep at night, go for JP Morgan, right? But U.S. Bank may open up maybe a slightly higher risk reward over the next 2 years, mainly because October 16th, the Feds gave a final approval for U.S. Bank to basically stick to their Category 3 level of Basel III Tier 1 capital ratios. And prior to that, I think most of Wall Street was expecting that the bank will have to scramble and to raise the overall cash cushion by at least 2 percentage points over the next 2 years. And now they have a 3-year runway for them to build this up. So based on the synergies from Union Bank that may be running around $800 to $900 million a year, plus the fact that they might be able to do something on the duration side, there will not be a significant amount of earnings hit to make this number work out for them. And the 3-year runway certainly gives them a lot of room to still stick to some earnings growth and not worry too much about exceeding the $700 billion asset size that basically puts them in the Category 2 level for Basel III Tier 1 capital. So that's much more of a speculative name, but I think it could surprise to the upside given that we know that it's a very strong underwriter. It's one of the rare banks out there that has delivered consistently 20+% in return on tangible common equity. And so for all those reasons, I think you should keep that in your back pocket.
All right, we appreciate those picks and your insights. Shams Afzal, Carnegie Investment Counsel, thank you so much.
Thank you.
Coming up next, economic conditions that have our next guest expecting a move to commodities and which ones he has on his radar. That's next on Schwab Network. Stay with us. We'll be right back.
For low of the day. Hold till then. It's an hour and 45 left. It can still go a long ways from here. Hanging out. Gosh. Chopping around, I don't like it. A little bear flag though. That's support right here. Come on. It needs to flush out of this channel too. Closing a couple there. Don't like that channel's holding. There you go. There you go. Little by little. Yeah, you gotta go nice and easy, Spy. Melty. So melty.
600.
There's a little more of a candle.
And what it means for your portfolio, we welcome in David Strzeski, CEO of Sound Planning Group. David, always good to see you. Thanks for joining the show.
Appreciate you, Caroline. Great to see you.
So, David, instead of focusing on the weakness that we're seeing this week, let's focus on next week and one of the key reports that we're going to get on inflation, of which, of course, is the personal income and spending, and as part of that, the
So a couple more right here. I went heavy on that.
Closely watches. The hope is that inflation continues to moderate, gets closer to the target, but I was taking a look at your notes, and you say the inflation cycle will have a lot more life in it than Powell and the markets are expecting. How does that play out?
Okay. Well, I have a different thesis on why inflation is occurring right now than I think Chairman Powell has. And that derives from the fact that Congress is printing and spending right now at a rate that is unprecedented. You know, Milton Friedman actually really solved this problem back in the day. And he said, you know, where is inflation? In economies that are printing money. And so what a lot of people may realize is that we're above 33 trillion as a nation right now in total debt. But what many do not realize is that since the debt crisis ended just before Independence Day here, we've added $2 trillion of additional debt to the bottom line, which is the equivalent of, and oh, by the way, 650 billion just in the last 30 days. 650 billion in a month. So we're looking right now at a spending spree that is ultimately the only thing, in my opinion, that is really keeping the economy going. And so as we see the continual printing, and you just connected here about banks, you know, I have big concerns about these banks and where they're going to be headed, and the margin compression that's absolutely there because they no longer have capital to lending with. The rates are so much higher. Lending standards are so much more stringent. It's very challenging for capital markets right now to be effective in doing some of the things that we've seen in the past. So I think that we're going to see some inflationary things, especially with the price of gas going up and the Saudis and Russia kind of being in lockstep with all that and looking at depreciating the amount of barrels on a daily basis. You know, so you know, the oil production's one of those things that's going to cause inflation, but this deficit spending is out of control, unfortunately, and you know, that leads us to having to print more treasuries. And really the reason why we're seeing these treasuries rise as fast as we were, and I wish Powell would have addressed this, but he didn't say it is straight, and you know, it's part of his job actually. But it's because, you know, the Fed's no longer buying treasuries. China's no longer buying our treasuries. They're buying gold, by the way. Institutional investors are no longer buying our treasuries. And in Japan, our number one creditor is tapering off of that as they're looking to control their own yield curve. And so bonds are just a supply and demand factor. You know, if the sellers want to sell, the United States needs to print a whole bunch. If the sellers want to sell more than the buyers want to buy, the price goes up. And so I think that's going to have to continue on because we're not seeing a high demand right now for people just excited to jump into the U.S. dollar as we're looking at a November 15th date here on having to have a House Speaker and budgets passed, or we go into another one of these shutdowns. So again, this is just not a peachy or rosy moment, in my opinion. I think a lot can go wrong from here.
Okay, so let's talk about what a lot going wrong looks like. Because if spending is keeping the economy going, but it's also keeping inflation high, does that mean we'll see more rate hikes, which will eventually push us into the recession?
Okay, so I think Powell is essentially out of ammo at this point. He doesn't know, he didn't want to raise it more because then he'll be, in trouble for raising it too much. He doesn't want to cut because that's the Volcker mistake that we saw in the 70s, and that's what caused inflation to just go through the roof. So he's not going to do either. He's waiting for the lag effect, which generally takes, 12 to 18 months to happen. He's waiting for the lag effect to show up. I just think that we're going to run out of time. And so, yeah, if banks have challenges, we're going to print. That's the tax of least resistance, by the way, as well, because we really should be, cutting our budget. That's really hard. You're not going to be raising taxes going into an election year. And so what's the answer? We're just going to print. So are we going to have to raise rates higher? I think that the bond market's actually already doing some of that for us. He may have to raise rates higher. I'm not really sure what that game plan is because we're in uncharted waters today. But as far as the challenges go, I mean, we're slowing down right now in production. If we just, look at all these union strikes that have been occurring this year, that's indicative of how the average investor is doing, how the average person is doing. They're not asking for more wages because they think CPI is going to go up in the future. They're having a difficult time making ends meet today. And so they're trying to say, hey, we need more money if we're going to be able to do this. And they've got that power. And so obviously higher prices to pay employees in smaller work weeks is going to bring the prices up, which is inflationary. For reshoring or friendshoring from China, as we recognize that challenge, well, that's inflationary as new infrastructure costs are going into place. And we're also, probably paying a more livable wage than we could pay. China was paying their people to be able to produce certain things. And so I see a very larger problem here today. And that stems from what Jerome Powell's already done. And so because he flipped the entire credit cycle, which for 40 years was just able to go down and down and down, now everything changes. And the reason why everything changes is because everyone is dependent on credit. Our system has been reliant on cheap money for more than a decade. And so that's gone. That's out the window. I don't think it's ever even returning. And I don't want to be a big bear that everyone's like, wow, this guy is the most negative person in the world. My vote is it goes back. I think everything pre-2020 was awesome, okay? But the reality is things have adjusted. And because the credit cycles touch every part of our market, I see this going to be as a rolling recession. I think we're going to have downturns and downturns and downturns as different parts of our economy face different challenges and weaknesses as it's sort of reshaping and restructuring. And we're globally having a lot more challenges as well with supply chains.
All right, so we're almost out of time. So I do want to just get to what this means in terms of your investment strategy. You say It's all about riding bulls and taming bears. So how are you riding bulls and how are you taming bears in terms of what you're doing to your portfolio?
Well, number one, I think that's a good title for a book that's going to be coming out here pretty shortly. I'm about 35 days from done with that. But so the goal here is to understand, know when to hold them, know when to fold them. When should we be in? We need to understand how cycles work. Cycles happen. It was a buyer's market. It's a seller's market. Okay. So we need to understand how do we deploy capital today in a way that's going to avoid the big challenges that we're going to have in the bond market. Many people are conservative today and they're loading up with bonds. And I'm going to say that is a very, very, very well, that might not be the best idea, just given some of these challenges that we have with higher rates, et cetera. So how are we doing it? Well, we need to be more individual in our allocations. We need to be specific in understanding how is the world changing here in the 21st century. And the world's changing right now because, tech has been this great leader. And I definitely think we're going to see tech companies, continue to improve, and AI is amazing and biotech's amazing. There's going to be some great breakthroughs. But if we look at where the S&P 500 is based on capitalization, only about 14% of the S&P 500 today is based on like commodities and like oil, gas, different metals and different miners and different places. It was about 50% in the 80s as we were ending this inflation cycle. So what I believe is going to occur is that we're going to see more of these commodity-based companies begin to get greater strength. They're going to become a lot more valuable and important because we're still building things, especially with the green new things that are happening. There are metals, there are commodities, there are things that are critical for infrastructure. And so I'm more allocating to ideas like that as an investment strategy, but it's really important to be hedged right now. Because money seems to be made like an escalator, little bit by little bit over time, but it seems to also be lost like an elevator when things get bad. And so what we have to avoid is these major downturns, especially if we're nearing or entering retirement. And so, just wrapping that thought up, it's things like gold and silver, it's things like copper, it's things like uranium, it's things like gas right now that are ultimately going to get the United States into a position of strength, and they're ultimately going to give us the tools that we need to be successful in the future.
All right, David Strzeski, CEO of Sound Planning Group. Always appreciate your insights. We'll keep an eye out in 35 days for that book. Thanks so much.
Appreciate it. Thank you.
Up next, a new name in the EV space is going public. The chairman of Ego joins us to talk about what their biggest backer calls an iPhone on wheels. Stay tuned. We'll be right back.
Took some more profit there. Just enough to entice it to drop more. Watch. Gotta do. Like you're not looking. Price action today is just liquidity, and then snap. Expecting my computer, making my computer do the same thing. Laggy. Dude, these guys don't know how to just chill. No one ever sees anybody's cards because they just bluff each other to death. Yeah, my computer. Format it again or something. Try and slow play him, hopefully get a good flop. All in. There's a little flush. Fell on two more there. That's this prior support, this prior inverse head and shoulders, which I actually called out, but then I got busy and didn't grab the calls. Yeah, we're back to that shoulder. Breaks here, we're probably going to see low day. I bluffed. And just crappy cards here too. Not getting audio. Weird. Really weird.
And in production, the next one in North Macedonia, nearing the start of construction, and there are a couple of more on the way. That basically gives you roughly the indication as to what is the overall production targets that we're trying to achieve. In terms of what are the challenges to achieve, what are the next steps, is simply prosecuting our business plan. The good news is we have the factory, we have the product, and our focus will be primarily on start of production and ramp up.
Ali, Elon Musk raised some red flags with his cautious commentary earlier this week about the higher rate environment here in the U.S., making it difficult to buy cars. They're talking about, trying to bring down the cost of vehicles to make it easier, which of course hits margins. But it's very much a kind of a macro story. So I guess how concerning is the current macro picture to you right now?
Elon is absolutely spot on this point. However, this is something that we've been preparing for, given regards to the choice of technology and the capital efficiency that comes with our end-to-end
Did just skip over my stop? Okay, I got stopped out of the rest.
We have been always trying to look at an environment in which the customers continuously look for value for money, whether it's under the pressure of increasing interest rates or inflationary environment.
I closed two more, then I quick try to get my stop back in.
They are primarily focused on capital light production facilities and very unique and very disruptive production solutions and material, from battery to exterior to the use of polymers and aluminum and so on and so forth, in order to make sure that we cut costs out of the process and be able to deliver to our customers a car which is affordable, practical, and fit for purpose. So as far as we're concerned, the pressure in the market, while applicable to all of us in the industry, is something that we are accommodating with our unique production solution.
All right, well, we have to leave it there, but certainly look forward to seeing these iPhone on wheels in the city here sometime soon. Ali Vetsvai, chairman of EGO, thanks so much for joining the show.
Thank you for having me. Thank you so much.
And congratulations again. All right, still ahead on the second half of the show, we're taking a deeper dive into Johnson & Johnson's latest
I'll grab
earnings
calls.
and the big
We break
trends
this
to
channel
watch in
again.
the healthcare space. As we head to break, let's take a look at some of today's winners
got
and
more
losers
down
in
there.
the S&P 500.
Just snaps. 8 days are designed to take your money, but in other days, find recognized early and trade accordingly, or don't trade. Can't leave that little stop hunt. What a juke. Look at that mess. Guess I could have left my stop off. Nah, I'm good. All very controlled today. Look at that price action, man. I'm doing my best not to trade anymore. If we get a break on this channel though, I might grab calls, but I don't think I'm gonna chase this. We could very well flush all the way to 200. That's the thing, there's still downside that could happen. That's just gnarly chop. Hopefully we've shaken this by next week. It's been what? It's been like these bearish days have been this way the last like 3 days. Started with Powell. A little bit. Wednesday, Thursday. Wait, this is Wednesday? Powell's on Wednesday, right? Yeah. Like when it's bearish, this price action is, it's like not, it's not like panic selling or capitulation selling. It's like, it's really weird. It's very controlled selling, and then just like little squeezes every now and then. But then the selling is just like liquidity, then woof. It's odd.
Indicated for type 2 diabetes. Now there are quite a few folks who have type 2 diabetes that are also overweight, but what you have to imagine is these are expensive drugs. They run about $1,000 a month. So if
it's really just like chop. Like I know we're down a lot, but it's really just big day of chopping.
Okay. There's also this deal
No
that
continuation really. It's just
between Merck and
controlled.
Daiichi Sankyo.
Today's that way. Yesterday was that way too. Like we came down, but
Daiichi up about
was that yesterday?
24%, but even Merck is actually higher on the
Powell's
news,
on
2.5%.
Thursday?
What stands out to you there?
Wait a minute. Is Powell?
And this is an interesting deal. It's roughly $5.5 billion up
Yeah, that's
front.
Powell.
There's some nuance into how that
It was
gets
Wednesday.
paid out. But the deal ultimately could be worth up to $22 billion.
Oh,
And it's focused around
did have that whips on Wednesday. Yeah, same kind of deal.
Oncology
Just
drug candidates where they seem
very
pretty
choppy on
promising. So there's
Wednesday.
excitement around this deal.
Controlled.
Obviously, as you mentioned, Daiichi's
Thursday
up
was
quite
the
a bit
same thing,
today.
even with Powell. Then you had the
And
Powell
Merck's on
deal,
tap,
and then
so
same deal.
before market opening.
Just
Before market
kind of
open
ugly
next
price
Thursday.
action. Same
I'd
thing
say what
today. I
we're
wonder if it's just because
focused on,
it's
of
like
course, is Keytruda, their blockbuster
different bearish
oncology
algos
drug,
or what?
as well as Gardasil 9 HBV, which has been really benefiting from very strong uptake in China.
All right, we're almost out of time, but anything else that investors should be considering when they're approaching the healthcare space right now?
Yeah, well, I would say the GLP-1 phenomena, if you will, is having quite a bit of lateral effects. You saw Fresenius and DaVita both tank on Novo Nordisk flow data. They stopped that trial early because interim analysis suggested it was going to succeed. This is showing Ozempic, a low dose, 1 mg, in slowing or stopping the progression of chronic kidney disease. So obviously the dialysis providers took a hit, and you're also seeing a lot of pressure on names like Dexcom, Insulet, and Tandem, which are either insulin pumps or continuous glucose monitors. So it's having a lot of effects, and we're actually fielding questions even outside of healthcare on what GLP could mean. Everything from airlines to consumer snack companies. So it's an interesting time.
All right, appreciate you getting us up to speed on the space. Lee Brown, Global Sector Leader for Healthcare at Third Bridge. Thanks so much.
Thank you, Caroline.
Have a good weekend. Still ahead, we'll bring in our panel to discuss American Express's earnings and how it stands up to its peers in the payments category. That's next. We'll be right back.
Young lady who was mid-30s, a couple of kids, recently went through a divorce. So she had a lot of questions when she came in. I watched my mother go through being a single mom At the end of the day, my mom raised 3 children, including myself. And so once the client knew that she was heard, we were able to help her move forward. Your client won't care how much you know until they know how much you care.
Download the Schwab Network app and join in on the latest market trends. Anytime, anywhere, on any device for free. Schwab Network.
Trading the trending names every day. It's Fast Market. Ready for you, ready to go. I'm Kevin Hinks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Cut the cord on the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage.
That's crazy, Guts. Yeah, I wouldn't expect anything today. Maybe next week. Maybe. Oh, Wheeler kept going. Wow, well done, Zip. It's crazy. Must have gotten some volume from day traders or something. One's bluffing, one's probably not. He's bluffing it. No, he wasn't. Jeez, Generac taking a dump. From downgrades, I guess. Slow play this flop. Ugh. I like it. Oh, I called. Oh, this is awesome. Hope someone has I hope someone has a spades. Hope someone has a flush. Please. Dang it. He has the flush. Cool. I wanted to check that down to see if he'd raise. It was risky though. He checked that with the flush. Well done. Little slow play. Grabbing some calls there. Let's see if we get a VWAP move. I don't know. Man, Kitty, don't say that. That's true. We're in chop. Hoping this chop breaks. Power hour. Bust all. High of the day. You can do it. Oh, in the world. Get rejected. One more job. I know better. I know better. I gotta stop trading. We'll probably make it back up to VWAP, but I should not have entered there. This dude always with the thanks. When did thanks become an insult? I'm trying to slow play a little bit, get some people involved. Jack. Good kicker. Oh, there's just straight. The sixes. Dang. That's why you want to check one down. See what people are messing with, not just push the whole time. There were so many people out though, I was trying to get rid of some at that point. 425. Yeah, maybe VWAP. Little Friday gift. Whatever you want.
You can bet that gold's going to be getting squashed, but for some reason it's not. Maybe this speaks to the geopolitics, perhaps, around the world that are putting a bid into what some deem as a risk-off haven. Doesn't work usually very well when rates are doing what they're doing right now. Gold's on a decent little upswing. Here's the only catch, though, in attributing gold's move to geopolitics, is that the move in crude oil, which is kind of our main lens through which we view the threat of geopolitics on markets and inflation and the main macro discussions we've been having, is that crude is still below the highs. Now, yes, we put in some higher highs and higher lows in the second half of this chart, which goes back 20 days. But also, we're still below the 95 that we put in earlier this year. So WTI is range bound, and for all the talk and speculation,
everybody's got a 9.
The geopolitical situation in the Middle East, and hopefully things don't worsen from here, of course, but the market right now just doesn't seem to really corroborate the notion that things are really going to get awful here. If that is, you're using crude oil as a gauge to assess that situation, and a lot of traders do. So WTI staying range bound is encouraging, I think, on the geopolitical front. And there still is another wild card happening in the background of all this. That is Bitcoin. So some of our secondary and kind of tertiary asset classes,
or Queen,
gold, crude, Bitcoin, There are some things that don't
Someone's
necessarily
gonna
line
not
up,
be bluffing.
like Bitcoin rallying when stocks are coming off as hard as they are. It's definitely a correlation break in Bitcoin's favor and could be attributable to ETF rumors and hopes and high probability that there's going to be a spot ETF. So maybe some kudos here to Bitcoin holding up a little better than I would have thought it is based on the ETF stuff. Now, of course, Bitcoiners are also going to try and spin in some of the macro situation, as of course we've had a couple treasury auctions that have gone awry. But generally, there still is more that we need to see fall into place before I'm convinced of that story. We're going to talk about what role the Treasury has played in market volatility with Markdown coming up. A few other things I want to put on your radar here. Number one is a lot of the tech move today is earnings based. It is coming from the Solar Group, which is maybe one of the biggest policy-driven letdown trades that I can remember. These stocks have just been getting creamed since a lot of them were included as recipients of some of the spending from the inflation bill last year. Absolute wreckage in the sector. But the other one that's probably more important for us to spend time thinking about is the regional banks. The group is down 4%, cutting through local lows, not back all the way to the March lows, but a little uncomfortably close. And so even though today's session isn't quite the same as some of the risk off we've gotten, we need to pay attention to it because a few of these earnings definitely are a little bit of a yellow flag. Let's talk about that regional situation with our own Alex Coffey here with me in the studio.
I'm gonna have a straight, I guess.
For those that missed it
Another
this morning,
pocket pair.
Alex, this is really centered on Regions Financial, ticker RF, which is cutting below the March lows. So take us through what happened here.
Yeah, worst move since March as well in terms of decline, down 12.5%. This is actually improved.
Glad I call. I almost folded that down. I'm like,
Speak here.
Pocket pairs can turn into nice trips.
Buyers coming in down $2 right now, 14.40. This is, as you mentioned, on their third quarter results. These results were misses on EPS. Comes in at 49 cents versus the 58 cents estimate. It misses on a couple key kind of internal metrics, though, that are really sensitive to the financial sector, and that is net interest income, $1.3 billion, the estimate at $1.33 billion. Now, granted, it's a modest miss, but in the scheme of the financial world right now, this had been a bright spot for big banks like JP Morgan, like Citigroup, go down the line. And so the fact that they missed what was already a relatively low bar being set by the street for Regions Financial in the landscape that big banks had crushed these metrics is critical. They also cut their year forecast for adjusted revenue to 5 to 6% growth from 6 to 8% growth. That is notable, alongside non-interest interest expenses up to 9.5% in terms of its growth versus what was before around 5% for the expectation. Now, we talked about this morning, Oliver, and I think the critical piece here is that comparison between the biggest of the big banks and these regional banks that, while are certainly not modest, they're very large banks in their own right, but compared to JP Morgan, this is considered a smaller bank.
Sure.
And
but still one of the bigger, smaller ones, because this is an S&P 500. This isn't a Russell stock.
Exactly right. It's publicly traded as well. So we're not talking about the local, savings and loan institution. We're talking about a big regional bank. However, these regional banks throughout this year, post kind of the March and April uncertainty, started to lose confidence in the deposit base. We saw huge outflows from these companies into places like JP Morgan Bank on the heels of some of the failures that we had seen. Now, as a result, to entice depositors back into places like Regions Financial and some of these other banks, they have been paying more on free cash. So their interest that they're paying on deposits has gone up substantially.
Oh, Jimmy got a little frisky
Companies
there
like
for a
JP
minute.
Morgan that have a plethora of
Let's see,
inflow in
5%?
deposits have not had to do that. So they're looking at very, very different dynamics. So what is a windfall for a company like JP Morgan at the moment is actually the exact reason the others are struggling. And so combine that with the fact that maybe those who are a little bit more risk on the credit spectrum are also going to some of these smaller institutions just simply for access to credit in what has been objectively a little bit tighter lending environment over the last few months. They also had to increase their provision for credit losses versus the expectation. Comes in at $145 million versus $135 million. This is, again, very divergent from what we saw from some of these other institutions that were actually showing much smaller numbers on those provisions. So it's really become a story of the haves and have-nots within these banks, and these dynamics are putting continued pressure not only on Regions today, but this entire sector.
Few things. One, about its size relative to the big ones. It is one that's going to have to change and abide by some new regulations from the Fed that actually just got pushed back a little bit. But that's something else to keep in mind. They are going to have to be watched a little bit more closely like the big banks. Two is that even though their lending did increase from a year ago, because they're having to pay more for those that are keeping cash in, they have to pay that higher interest. They also are widening out a little the credit spectrum, it seems, to keep customers in. The third point, though, I'd say to put it all together is that it seems like even though, yes, some of these are macro-driven forces, like having to pay folks to keep their cash with you, it's also very much of a competitive element. And this all kind of screams to me that maybe there is a solution here through consolidation of the industry like we've already seen through big banks like JP Morgan, as opposed to like big explosive systemic solution to the problem.
Yeah, and it's one of those
Spy at the bottom of that
situations where
channel.
further consolidation can be beneficial
Right,
for
so
the
you've got
industry, but then it's
room
the
to the
question
downside,
is that
but
beneficial for
man,
the
it's so
consumer?
choppy. I closed out of my calls, took a
always
loss.
be sort of that cat and mouse game, that back and forth pull.
Could have been
but
more content with
clearly,
my gains
right
today.
now there's a very
Such a
clear
crappy
divergence
day.
between some of the biggest deposit institutions and those who are hoping to one day be big institutions that are in their own right very respectable sized companies and doing a lot of things well. It is a story that didn't end in March and April. This is just the next chapter, and it's back on the table once again.
Absolutely. Okay, well said, especially since we also did get new fresh lows in Morgan Stanley, Bank of America in the past week, JP Morgan, kind of in a world of its own, at least holding things together for now. But an important update very much as we do have more of these companies set to report in the coming week. Thanks a lot, Alex. Important move here as region's still down 12.5%. Let's bring in Mark Dow, author of Behavioral Macro, joining us here to try and piece together some of the puzzle. Mark, kind of down to the brass tacks first, on the phone with us per usual here. And good afternoon, Mark. Thanks for coming back.
Good afternoon, Oliver. Thanks for having me back.
Hey, let's first talk about rates, obviously. Is there anything stopping this train of the bond market in your mind?
Potentially. I mean, we saw the first signs of hope, at least if you want to call it that, yesterday when there was an outside reversal in the 2-year. And
yeah, there's a flush.
That was followed through on a little
All
bit
right,
today
for low of the
by
day.
a bid in the back end in the long bond. I'm just gauging by futures.
Just the
we opened
liquidity
this morning, pretty ugly
areas are just
in the
large.
long bond futures, and that reversed nicely, and the bid held up
Big range
over
on
the
them.
course of the day, even as equities deteriorated. So
big.
if you take those two things together, they're the first two
Just you have to have a
initial
long,
signs of
a lot
hope,
of room
right?
for your
It doesn't mean
stops,
that it's
which
going
is
to necessarily turn around, but
not great.
finally something to hope for, because honestly, for the past couple of weeks, it's been a one-way train.
How much of this move has just been an effect of the market's sort of obsessive pricing of rate cuts in an economy that's just too strong?
Well, I think there were a couple of things that hit at the kind of at the same time. So you had, for a while, the Treasury wasn't allowed to issue because they, shutting down the government and the debt ceiling debate and all that kind of stuff. And when they opened things up, they had to issue a ton of T-bills immediately, replenish the Treasury general account at the Fed, et cetera. And that scared a lot of people. They saw that. They saw the budget deficit not shrinking the way it was planned to have at the beginning of this year. And people got a little bit scared, a little bit nervous. And then we had kind of a catalytic moment when the recessionistas finally gave up the ghost. They said, okay, it is going to be higher for longer. The economy is much stronger than we thought. Inflation is coming down, but they really can't cut if the economy is this strong. So people were looking over the horizon at a lot of supply. They saw that the hopes for recession were diminishing or had diminished significantly. And they said to themselves,
I'm
why
not
should
cut
I
it
hold
early,
a
guys.
30-year bond at 100 basis points through a T-bill, right? At a yield give up of 100 basis points or so.
Review the trades here real quick. I didn't do a whole lot of trading
If
today.
there's not going to be a
Just
recession,
good.
the only reason you want
Green on the day
duration
somehow.
is because you think the economy is going to slow down.
Yeah,
Right?
back
And if it isn't, then you need
almost
to
half my
compensate
profits
me
on that
more than
stupid
you would in a
ball,
T-bill
though.
for me to hold that duration. And those two things kind of hit together, and we started this sell-off. And then once that happens, narratives kind of take hold, whether they're true or not. They can gain traction, and then they feed on themselves. They're kind of self-propagating for a while, particularly if positioning is offsides. And of course, it was, with so many people looking still for a recession. And then we heard about geopolitics and the unsustainability of the U.S. debt, and people want to get away from the dollar. All these things that
Thanks, Hugh. I'm gonna do my trades here real quick. Wrap up the week. Got let's see, I was in for puts, 5 of them for Monday at the money at 9:45. Oh, right here. Yeah, that was a bad entry. I didn't like it. This is why I got stopped out of them. Had a good entry. I probably could have held those a lot of the day, or at least for much more of the move. Sold 2 for a profit at 9:51. So right here, when it retested, and then stopped out of the other 3 in that same minute. Somehow that happened. Just at the end of that minute. Crazy, yeah, it was close to my stop. So yeah, then I was out of all those puts. Too bad. And then I was in more puts. Right direction, so that's good. 1039. Right here. Right here, yeah, right there. Not the greatest entry. I don't like this price action down here. Not unless if I'm already in it. If I'm already in it, that's fine. If I'm getting in here, it's just too stressful. There's not a good setup. It's just tapering, a rounding bottom. I knew it, and that's why I didn't hold these. Sold one for a profit at 10:45. So literally right there on that candle. That is neat. And the rest stopped out at 10:46. But yeah, bad entry. You're gonna get bad stops. And then 11:48. 5 calls. Right there. Channel break was a little late. I want to make sure it was confirmed. And then I sold them all at 12:03 for a small loss. Yeah, I didn't take any profits on that one. And wrote it down to here. That was dumb. That was basically break even. But those were up pretty good at this point. I was waiting for VWAP, and then I was waiting for the pullback, and then it just, nope. So there's your chop. Bought 10 this time, so a little heavier. Calls at 141. I was upping my position size. Which I shouldn't have at this point. Even though it worked, I shouldn't have done that. It wasn't at the bottom of the channel. There wasn't a whole lot of risk reward. Wasn't great. Should not have upped my position size. At any rate, 141. Bought 10. Sold one at 142 the next minute. Sold one at 143 the minute after. Sold one at 144. Still green on them. Sold 2 at 144. Then sold 5 for a loss. Overall, I don't know how I did on that play. On that one, I'm not sure. 149, I sold the rest. Just saw a double top. SPY's bouncing right back up. Yeah. Yeah, I can't move fast enough on Fidelity to get a stop loss in there. Otherwise, it would have stopped me out, but I had to manually close it. 211. So I increased my size on this one quite a bit because of my conviction and because of the setup. It was this one right here, this channel break. So drawing resistance lines on this uptrend, and the parallel line down here with the support. Look, now SPY's right back up where I opened them. There it goes. Here we go. I'll do a golf clap for SPY right now. Yeah, so I actually got 20 contracts here, which is the only reason why I was able to be green on the day, because those other trades weren't helping me out. But thankfully they were somewhat smaller, And then this one, great conviction, great size, something like that. This stupid chop. 211, yeah, so about 20 at 211. I didn't go on my channel break a little bit after that. Just again, I wanted to be sure. So got him here, and then it just kind of chilled. I'm like, it's bear flagging, but how choppy it was, I was very, very nervous. I sold 2 at 216. Right there. Sold 2 more at 216. Still had quite a few though. Still had what, 16 left? And finally dropped some more, gave me a little more cushion from my cost basis. Sold 2 more at 218. Right here. Sold 2 more at 221. And right there. 2 more at 226. Right there. 2 more at 230. Right here. 2 more at 234. And this is when I was trying to quick get out of it. I sold those there. And then I was trying to put my stop in really quick. And then I stopped out of the last 6. So I could have closed all of them there for a little more, but oh well. But turns out it was just a chop. So it didn't matter anyways. Yeah, that was pretty much it. And then these dumb calls I got right here. 56 out of boredom. Here. Yeah, right there. And closed them. Manual stop at 309. Wait all the way till here. And that's it. That's what I got. A green day though. That's a position sizing. It's all about position sizing. It has to be matched and scaled to your risk tolerance, to how quality of a setup it is, to your emotions, to your profit and gains so far in the day, your stamina. There's so many variables that can go into your position sizing. It's best just not to overtrade and only go with large position sizing, because then you know you're gonna have conviction. It's gonna be good. But if you can trade some small ones with maybe not the best setups and still profit on those, that's even better. But if you have a nice setup, a good setup, you gotta be willing to go big. And yeah, that's what made me green today on this choppy day that I really traded quite poor, somewhat poorly. No, I guess my trade here was good. The stop was bad entry too late. Here, stopped out. Calls were good. I didn't take profits though. Right here, it was a chop. So I guess not terrible. This was a stupid trade that I did here. Other than that, pretty good. Just need to take profits here and earlier entry there. But I was down on the day, but I still had buying power. I still had the energy and the focus to be able to catch the breakout to the downside or to the upside on this one. Tried to the upside, failed, up downside. Just that tiny little move. That was it. Crazy. Thank you guys for your support this week. Hope it was good. I'm actually red on the week, I believe, on the trading account still. Yesterday was a pretty big L. The day before was too large. So that's okay. That's okay. Next week, continue on. I'm going to be using TD Ameritrade. Be doing some more dailies, which may or may not go in my favor. I have to do some adjusting. We also have, let's see, 2 weeks till the end of October. I appreciate it though. Thank you guys for all the support. Have a good weekend. Chill out. Take it easy. Thanks Tony T for the donation, the support. Thank you guys for your thumbs up. Got 21 on the day. Well done. Look at that SPY. Thankful. The green. Okay. Thanks, guys. Have a good weekend. See you on Discord. You on Twitter, maybe? You, Mr. Invest, Kitty Daddy, Guts, Psych, 20T, Bubba. Appreciate you guys. Have a good one. Be good. Be back here on Monday. Thanks, Kitty. All right. See you guys. See you later.